When we look at what's happening with the consumer, which is the backbone of the U.S. economy, we are seeing a clear loss of momentum.
Further deterioration in the labor market, we're starting to obviously get a flavor of that.
The danger is we have to go higher in rates, and it lasts for longer than what the Fed is even looking for.
We don't think they're going to cut by the end of this year. We do think early 2024.
It's going to be a recession, but a mild recession, so it's a hard landing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro in London, Lisa Abramowicz and Tom Keene on a Friday to get set for the weekend and a Fed meeting coming up next week. We welcome all of you here on economics, finance, investment, on John Ferro's tax bill in the United Kingdom. We'll get to him quickly here in a moment. The Chancellor of the Exchequer speaking at our Bloomberg offices in London.
Yeah, but still you're saying that John is responsible for some of the proposals out there. This is going to be curious to see, especially how much he's going to get some of the support behind him after the turmoil that we saw earlier last year.
Emily Ashton reporting on it for Bloomberg News. I love this idea, a catalyst for prosperity. I think that's a post-Brexit angle. We'll talk to Anna Edwards about this here in this half hour after a conversation with the Chancellor. I'm going to look at the data here, and I don't know what to make of it other than what is this week? The surprise for the bears, equities up. All week is the key word.
Let's tie the two ideas together. What Jeremy Hunt had to say, the Chancellor of the Exchequer over in the United Kingdom, and what we're seeing in markets. It is money out of the U.S. and to everywhere else. It is to Europe. It is to emerging markets. We saw nearly record flows to the emerging markets, to Europe. How much can that continue, given that this really has been the pain trade for the past decade? Is this something that can be sustained?
I want to get to John Ferro here very quickly with his important guest, Mr. Oppenheimer of Goldman Sachs. Let's run through the data before the brief. Lisa, to me, the headline item, the VIX under 19.
The headline item for me is start with weakness, end with some gains. And that's been really the theme of the week, that even if you do see potentially negative news, the market can rise above it by the end of the day, given the rally that we saw yesterday.
3.54% on the 10-year yield. 2s gives me nothing. Real yield 1.21% as well. Dollar churning, maybe dollar a little bit weaker here. We got to go to sterling, 123.75 before a sterling brief on a Friday morning.
So yesterday, after the bell, it was all about Intel and the earnings that came out that were highly disappointing for a lot of people. Those shares are down. Today, the earnings, yes, and just to sort of push it forward, today we get Chevron and American Express before the bell, but this is all just the lead up to Apple, Amazon, and Alphabet or Google, which all come out Thursday next week. We're getting the real economy this week. We're getting the tech economy next week, and this really is going to be key in determining the path for the index going forward. 8:30 a.m. is the data dump that we've all been waiting for, U.S. personal income spending and core PCE. Core PCE, I keep focusing on that. How much do you see it decelerate? Yesterday, it came in pretty much in line with the quarterly look. How much does it actually decelerate and give the Fed some reason to follow what the Bank of Canada did and really give a little bit of a dovish tilt? And at 10 a.m., University of Michigan Sentiment Survey. What's good news and what's bad news? If it inflects upward, is that good, or is that basically signaling that perhaps the economy isn't in such dire straits as people are expecting to get this soft landing? I'm curious to see how people interpret, how the market responds to a survey that has been inflecting negative for a while.
He was in London and was seen in the corridors with the Chancellor of the Exchequer. Ashton and Wickham of Bloomberg News report the Chancellor of the Exchequer, Jeremy Hunt, dismissed calls for tax cuts, warning that John Ferro must pay his fair share. Joining us now from our offices in London, John Ferro. John, your accent is changed this week. It's worse than normal.
Just to be clear, I am funded in dollars, Tom, for the 10th time, and that's where I pay taxes as well. I want to clear that up. And for the second point I'll make, Tom, the Chancellor was only here to warm up the seat for Peter Oppenheimer of Goldman Sachs. Peter joins us right now, the Chief Global Equity Strategist. Peter knows that. Anyway, Peter, you're a popular man this year, and good afternoon to you / good morning, I guess. European equities, that's what it's all about. It's conference season. When you go around doing these conferences, do they buy the hype in Europe after hearing it for the 10th time in the last 10 years?
Very slowly, people are warming up to it. And it's been a long time coming, I know that. But performance attracts investors. And we've seen, a 30% rebound in the European market since October, at least in dollar terms. And that is starting to energize a bit of interest in the region. And it reflects the big shift we've seen towards value. Again, something we haven't seen now for more than a decade.
So clearly we've priced out recession, we've priced in stagnation, and investors are focused on the difference between the two. I get all that, but now we need to talk about the difference between stagnation and real recovery and expansion, and that's been a theme for us this week. When do we start to focus on the fact that there is no growth in Europe? It's just an absence of a recession, and what we've seen so far is a bit of a squeeze, a relief rally, and perhaps nothing else.
Well, I think we need to put it in context here. We think that the global economy is in a relatively good shape, and we expect to see a soft landing in the US, but we also now expect to see a relatively soft landing in Europe. The falls in gas prices have helped, the pickup in China as well. But the absence of recession, as you say, doesn't mean we're yet into a strong recovery cycle. And I think the rebound that we've seen in risk assets in the last couple of months is overstating the potential from here at the index level. We've got flat returns in the US this year, slightly positive returns in Europe, so we prefer Europe. We think most of the action is going to be below the surface of the index.
Well, let's talk about those opportunities. Banks have ripped in Europe. They're up about 50% from the July lows. I picked out a minor because I know you like some of those names as well. Rio since October's up something like 40%. These are huge monster moves. And credit to you guys, because you got on board this banks trade in Europe at a time where I was sitting there thinking, you've got to be kidding me. We're going to get rate hikes from the ECB. It's going to crush the economy and peripheral spreads are going to blow out all over again. Why has that trade worked? And why do you think it will continue to work?
Well, I think there are three things. First of all, the recession that people feared 6 months ago is not happening. There was a point where the market was pricing in quite a big downturn in the European economy. The expectations there are adjusting pretty quickly. We actually have 0.6% GDP growth across the Eurozone this year. So the economy is growing, not shrinking. That helps a lot. Second of all, the rise in interest rates we're seeing is material, given where they came from. Remember, just a year and a half ago, 25% of all government debt in the world had a negative yield. Now that doesn't exist. European rates were negative. Now they're positive. The leverage to that in terms of net interest margins is the real game changer. And bear in mind that corporate balance sheets are reasonably healthy. So loan losses and the risk of a big downturn hitting banks is just evaporating. And the third factor is they were just really cheap, and they remain pretty cheap. They're cheaper now when you look at the multiple relative to the market than they were even during the sovereign debt crisis.
We started this conversation by you talking about how challenged the index level is. We've talked about that a lot in Europe. The absence of tech in Europe as a big weighting in the overall index was seen as a weakness for a long, long time. Is that a strength this year? Because I'm looking at the year-to-date performance of some of these tech names. Lisa was just going through them. Those tech names in the US, despite everyone saying it's game over, they're flying year-to-date. Is the absence of big tech in the index in Europe a weakness or a strength?
Structurally, it's a weakness because there is going to be more growth in the tech sector. It's going to remain the most important driver of growth, I think, for the next decade. The constituents are likely to change over time. That's always been true of technology in the past. You'll get new innovations which will generate higher returns. And so I think it is a problem in a way that Europe doesn't have many big tech names. But of course, the recent rally we've seen in tech is partly because of this rally, again, in bond yields, interest rates coming down because of fears of inflation moderating. And that's helped the longer duration parts of the market. I think really the whole concept of being in growth or value, which was really driving the markets over the last decade, is not really the story anymore. I think you need to have a much more eclectic mix, including deep value areas like commodities and banks, but also companies that can sustain stable margins and earnings. And some of that will be in the tech sector as well. Europe does have many of these, maybe not specifically in technology, but our group of what we call the granolas, the 10 really
which you've
big,
talked about before,
super-sized companies in Europe, which are mainly in areas like consumer staples, luxury, healthcare, and some technology. These companies are about a quarter of the index, and they're still growing because they're generating stable margins and very strong cash flows, and I think they'll continue to do well.
I've got time for one more. It's interesting to me that the market always seems to dictate the stories we talk about. Price, shapes, sentiment, you know that. And the headlines often come about from where the market is on any given week. And clearly we've rallied year to date in Europe, and clearly we've rallied over the last couple of months, and clearly we've priced out a recession, and clearly off the back of that the conversation and the tone of the conversation has changed. Being here in London this week, you can't escape the fact there is still a war in Europe. And for many reasons, based on what's happened over the last month or so, there are reasons to sit here and say that war has the real potential of escalating again. I understand we've escaped what could have been a much, much more brutal winter on the continent. I'm just wondering this hour, and I'm going to have this conversation with Amrita Sen of Energy Aspects in about 40 minutes, how long before we start worrying about next winter in Europe and what is actually happening in Ukraine?
I think you make a very good point. Part of the optimism that we've been seeing priced in is based on the collapse in gas prices. That reflects really two things: a very mild winter, which we can't assume will be repeated next year, and also a very weak Chinese economy that allowed and enabled European governments to find other sources of gas supplies. And as China recovers and Europe needs to restock its gas supplies at probably higher prices, that issue will come back. And that's again why we're slightly more tempered in our optimism about the pace of the recovery at the index level over the course of this year, not just in Europe but across equities overall.
Peter, this was great. We're going to make it up to Manchester this evening to watch Arsenal Man City. Is that happening?
You're going.
TK's trying to make it happen for us. It's amazing, Tom, how easy it is to get tickets over at Manchester City still, the Etihad. You know what they nicknamed that stadium, Tom? The Etihad, the empty had. Still,
Really?
It's that easy to get tickets for Manchester City.
Why does no one show up to see that magnificent team? I'm serious. I mean,
I'll let Man City fans speak for themselves, but I can tell you, Tom, last weekend when I tried to watch Arsenal versus Man United, almost impossible to get a ticket.
Yeah.
This week, looking at Man City versus Arsenal, very straightforward, very simple.
Well, it's a great country. You've got a train ride there 2 hours and 3 minutes, John. That does not happen in America. John Ferro with the wonderful Peter Oppenheimer in London, and an important interview coming up with Amrita Sen. We're going to pause the program right now, and Lisa Abramowicz and I are going to go all engineering tech. Lisa, Intel 4 failure, Apple A13 Bionic success. That's really what this is about.
That big tech is not monolithic. You're seeing real divergence, and Intel really highlights that, especially with even other chip makers doing okay this morning.
It's going to be interesting. JP Morgan, their price target on Intel, along with a lot of others, $32 down to $28. Stay with us from London. From New York, this is Bloomberg. Coming up, Anna Edwards.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Bloomberg's learned that Vladimir Putin is planning a new offensive in Ukraine. The Russian president is also preparing his country for a conflict with the U.S. and its allies that he expects to last for years. The Kremlin wants to show its forces can regain the initiative after months of losing ground. It's hoping to force Ukraine and its backers to agree to some kind of truce. The International Monetary Fund is considering an aid package for Ukraine worth as much as $16 billion. Bloomberg's learned there are still a number of conditions, including endorsement from the Group of 7 nations. Ukraine's government would also need to commit to a series of policies. Bloomberg's learned that Japan and the Netherlands will join the U.S. in limiting China's access to semiconductor machinery. The alliance is aimed at undercutting Beijing's ambitions to build its own chip capabilities. U.S., Dutch, and Japanese officials are set to conclude talks as soon as today. A new survey of economists says the European Central Bank will go for 2 interest rate hikes of 50 basis points on its way to a May peak. Then, according to the survey, the deposit rate will be held at 3.25% for about a year. Economists expect a struggling economy will eventually lead the ECB to cut rates. And more losses for Asia's richest man. The sell-off of Gautam Adani's corporate empire accelerated on Friday, erasing more than $50 billion of market value in less than 2 sessions. The fallout from a report by Hindenburg Research has investors keeping a close eye on the $2.5 billion share sale by Adani Enterprises. The Adani Group disputes Hindenburg's allegations of corporate malpractice. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
The first thing we have to do is the Prime Minister's plan to halve inflation. That is going to require patience and discipline. when we are able to, no one wants to cut taxes more than I do, but we have to recognise this is the priority for business as well as consumers right now.
He is the Chancellor of the Exchequer of the United Kingdom. His name is Jeremy Hunt, and particularly for Awaking America, how do you know him? He is the gentleman that made the best Olympics in ages work. He is the guy who did the London Olympics. He is expert at organization. Also expert at organization, always in London, is our Anna Edwards, and joins me and Lisa Abramowicz in New York. Anna, let me just start with a basic view from 60,000 feet. With your coverage of Downing Street, with your coverage of the Bank of England, you're truly expert at this. How's that Brexit thing going? Is the Chancellor happy with the experiment of Brexit years down the road?
Well, he was not one of the people who voted for it. Good morning, Tom and Lisa. He was one of the voices that warned against it, but he's turned his view around, as many in the ruling Conservative Party have done. He was talking about the virtues of it, the freedoms, and there is one. Getting rid of some rules around insurance means a whole pot of money in the private sector that will be able to be invested in green technology. So that's a sort of tick for the things that Brexit allows the UK to do. But on the other side of the ledger, there are plenty of voices saying, hang on, investment is below G7 levels. There are plenty of headwinds against the UK economy, and some of those can be attributed to Brexit. Investment is one of them. The CEBR says that the economy is 5% smaller than it would have been had we not seen Brexit. So maybe the jury's still out on that one, Tom.
Well, the jury's still out there. You know, Anna, when I come to London, I go deep into the west, call it Heathrow. I go way north, you know, up by Euston and the rest of it and all that. I don't get into the rest of the United Kingdom. How is the Chancellor and his party doing outside of London across all of the United Kingdom?
Well, we have a nifty little phrase for all of that here in the UK. This is levelling up. This was introduced by this government, this phrase, and it basically means trying to rebalance the economy from the heavyweight that is the southeast, the place that you frequent, Tom, when you visit London and its surroundings. Try and rebalance some of those growth opportunities around the country. And frankly, based on Bloomberg analysis, the government is not living up to its own commitments around levelling up. They set out a number of criteria that they wanted to measure themselves on, and of course the pandemic and a whole load of other things got in the way. So that one is still a work in progress, trying to bring opportunity to other parts of the country.
Anna, how cohesive is Jeremy Hunt's message at a time when they really don't have the money? They can't necessarily raise taxes. They're not going to cut taxes, but fiscally there's a lot of constraint there. And they're facing off with Europe and the U.S. that are pumping money into tech, that are pumping money into segments of their economy that they think will grow a lot.
Yeah, absolutely. A real shift in the geopolitics surrounding the UK right now. So the UK is now outside the European Union. So it's not at the table when the Europeans have those conversations about mobilising 400 billion euros worth of 300 billion euros worth of money to take on the Inflation Reduction Act in the US. The Americans mobilising, as you know, $400 billion worth of funds. So in amongst all of that, what does the UK do? The UK doesn't have that kind of firepower. His answer is that businesses don't just want subsidies. Subsidies are not the answer. They're concerned about the IRA, as you call it. And he thinks that other things will attract business to the UK. That's his pitch.
Do you get the sense that things are more stable, that we're not going to see a redux of what happened last year?
They definitely have done a lot to try and turn the page on that one. I mean, I think that there are still limits on the manoeuvrability of the budget, for example. That's coming up in March, that will still have hangovers of what happened in September, October. That mini budget really marking the UK out as something that people had not expected on the international stage from an investment perspective. So there's still that legacy that they still have to deal with, and that still ties the hands of a government that is facing strike action and would perhaps like to spend a little bit more on people's salaries, but they have limited room to manoeuvre right now.
And I'm fascinated by the relationship, and this is after, you know, my distant view of the tumult of Prime Minister May, Prime Minister Johnson, Prime Minister Truss. What a sense of chaos. And yet we would look at the city as just moving forward effortlessly. What is the relationship of this Chancellor of the Exchequer with London's Wall Street?
Well, I mentioned the freeing up of the money post-Brexit that's on insurance company balance sheets. This is called Solvency II, if you look for it in the literature. And if you remove the UK from the Solvency II regulations, the argument is there's a lot of money to invest in private sector activities, such as greening the economy. And the UK's Wall Street, as you put it, likes that quite a lot. So they like that stuff. There's always some tension around passporting and the post-Brexit reforms and the city not getting what it wanted out of the aftermath of the Brexit Brexit conversation. But we have been through leader after leader, and there has been plenty of turmoil. And, yeah, somehow the city manages to keep its head.
And one final question, if I could, and that is, what is the opposition doing? John Farrow's explained to me 4 times over a beverage of my choice the British election cycle. I still don't get it. But does Labour have a dramatically different Chancellor of the Exchequer view, or is there a solid middle ground, maybe like there were in the Blair-Brown days?
Well, that's an interesting question. I mean, 2024 is when we get the next election, and the important thing to note is the massive gap between the two parties in the polling. So post the mini budget, post the chaos of the aftermath, the downfall of the Boris Johnson administration, the Labour Party, the opposition, has opened up a massive polling lead, 20 percentage points at some junctures. That is huge. That's not very common in British politics. So that is something that everyone is looking to. And it's the fact that we don't have an election this year, perhaps, that means we're not going to see any of the tax cuts, and that was Jeremy Hunt's message today. But we wouldn't necessarily rule them out before we get to an election in 2024.
Anna Edwards in London, in conversation with the Chancellor of the Exchequer, his remarks at our Queen Victoria Street headquarters today. Anna, thank you so much for that leadership, and look for that out on Bloomberg Digital as well. We spent so much time on the clear and present danger, John traveling to Manchester, that, oh yeah, there's markets out there, and there's a stagger into the weekend. Lisa, how are you setting up for weekend reading and into a Fed meeting week?
Has this rally gone too far? Has the optimism gone too far? Have we already priced in all of the gains that people expected for the rest of the year? And how will we know? And honestly, how much can we see this feeling that the Fed's going to pull back from some of the rate hikes that previously were expected, given some of the momentum that we keep seeing in a lot of the underlying data?
I agree. And what's fascinating to me, and it can be any different chart, equities, bonds, currencies, commodities, everything's sort of up as a general statement, at resistance, as the technical people would say. And the answer is, what's the breakout? What's the catalyst to leap up? And the one insight I could come up with is I've got too many people sitting to my left modeling out 3% inflation. And I find that just, we're not there yet, and they're saying we're going to get there.
And some people being even more aggressive, saying we're going to get down to 2% by the end of this year. Next week, the tech earnings are going to be really key, not only with what they're seeing on the ground, the bifurcation. We talked about Intel, for example, on one side and Apple on the other. They're doing very different pictures. Even Taiwan Semiconductor Manufacturing, they're doing okay. They're doing better than good, with Intel still flat on its back. Well, so a real bifurcated picture here. How much does tech give us a sense of what's coming up and their ongoing dependence on China?
A lot of people writing on Apple sort of as the bellwether next week. I guess it's got to be. It's the biggest stock in the solar system, or at least the focus here. I know Jim Suva over at Citigroup paints a constructive picture, but also Mr. Suva and others, this complete mystery of the flows of Apple with Apple's China. Nobody really knows.
And how much they cannot extricate themselves from this nation. I mean, again, we have a lot of public officials, whether it's in the U.S., whether it's in Germany, making noise about, creating a bigger fissure between the U.S., between the West and China. It's not happening when you take a look at these companies. They are dependent on China, and you're seeing that really double down, especially with the reopening of China and the potential consumer spending there.
I'm going to go back, and of course, in this day of a generational shift to Toyota in Japan, not betting on the Pacific Rim is a hazardous process.
Well, it certainly has been
over
this
many,
year.
many decades.
I mean, so far.
I can understand Apple continuing with the China discussion, even if many others don't. Futures at -9. I'm going to call it a churn to the market. The headline, the VIX under 19. It is some form of bull market. George Bory coming up. He's chief investment strategist at Allspring. Stay with us on a Friday. This is Bloomberg Surveillance. Good morning. Bloomberg Surveillance. Good morning, everyone. Lisa Abramowicz and Tom Keene in New York. John Farrow with an accent change in London. Do you agree with me? Like, I can't, usually I can't understand like 1 out of 5 words, and I think we're down to 1 out of 4 words.
Okay, come on. You understand him. He's perfectly understandable to anyone. He's sort of more universally understandable than I am. But I will say that it's really hard to go somewhere and not start to adapt to
the language
accent a little bit.
Yeah.
I mean, honestly, it's easy to make fun, but it actually, it's hard. You reflect what other people are saying. I'm just saying.
I don't have a life, so I don't go anywhere, so I don't know what that's like. But I know when you were in Fargo of the Dakotas, your accent changed as well. John Ferro and Rita Sen coming up on oil, and I'm going to get your attention. A data check, Brent crude, $89 a barrel. The first thing I checked this morning was a 90 print. We're not there yet, but this is a backdrop this week as a lift, to say the least, in oil. Lisa, I'm sorry, a gallon of gas, however you want to frame it, all of a sudden it's a February topic.
I'm so glad you brought this up. Gasoline, $3.50 on average nationwide. Still pretty low, but the low at the end of last year was just $3. So it's just marginally creeping up pretty steadily at a time when a lot of people expected this to bleed into the consumer spending appetite.
Red on the screen, it really hasn't rebounded, but every day this week we get red on the screen and then boom, up we go with some form of bid. The VIX 18.87. Yields giving me some discussion, 3.56% on the 10-year yield, 4.22%. Higher yields all in all, but don't want to make too much of it. Who does make too much of it is George Bory. He's Chief Investment Strategist at Allspring Global Investments, and thrilled he could join us this morning. Do you have to rewrite your strategy on January 20 whatever versus what you wrote on December 28th?
Good morning, John. Good morning, Lisa. It's great to be on the show once again. Not at all, John. In fact, much of our strategy was written back in November in anticipation of a January print. So as a strategist, I'm pretty happy about sort of where we are, at least cyclically, where the markets are. And we did expect a better start to the year. But the central message from us is that for bond investors, it's still a pretty good environment. Growth is coming down. It's slowly coming down, still pretty good, but coming down. Inflation's coming down. And as we'll see next week, the Fed is still very much in tightening mode. This is the polar opposite of where we were 12 months ago. And for bond investors, that's generally a pretty good thing. And you pointed the 10-year. 10-year's been chopping around 3.5%. And we're likely to be there for a while.
George, help me. John Tucker and I used to do a wonderful thing in the radio studio of the opening of his 401k envelope. And Tucker informed me the other day it's become a 201k due to bond losses. What does Allspring and the representation of the Wells Fargo family across this nation, what do you advise as a strategy for people like John Tucker that have been blown up last year in bonds? They need to recover, but they don't want to buy Apple Computer. How do you recover in the George Bory space?
Well, bonds can do what they're supposed to do today. And if you look at where bond yields are and where we got to last year, the downside, obviously, of a meaningful repricing is your mark-to-market's gone down. The bond yields, the income that you can earn has gone up substantially. But bonds can basically do what they're supposed to do. Number one, generate income. Number two, provide you with a buffer against future volatility. And number three, we do think bonds ability to provide diversification, it's coming back. That extra income, that higher coupon, it will provide some buffer against, sort of correlations as we move forward. So you're not going to earn it back in 1 year, but you will earn it back. And making sure that you're positioned appropriately on the curve so that you can compound your returns as you move through time. When we look at yields, we can build portfolios anywhere, average yield somewhere between 4% and as high as 8%. That's actually a relatively attractive opportunity for bonds. There's good cash flow generation there. And importantly, there is the potential for some capital risk, capital appreciation. We don't really have that penciled in all that much for this year, a little bit of duration. So we think prices can go up a little. But as I mentioned before, the 10-year is right around 3.5%. We think it's going to be there for most of this year. Lisa's talked quite a bit about credit spreads. We've seen them rally actually year to date. We're probably going to give a little bit of that back. But what we tell bond investors, 90% of your return comes from carry. It comes from income. That's what a bond is supposed to do. It's generate a very predictable, very precise, and very manageable stream of cash flows. If you're using bonds to do that, even the ones you bought last year, they're still doing that. The price dropped, but they're still generating the income that they were supposed to do when you bought them.
Basically, this is a way of saying they're supposed to be boring. They should have been boring last year. They should be boring this year, but they're getting back to it, and they can provide that kind of benefit to a portfolio. How much of a liability is the fact they've been anything but boring? The incredible down market, the bear market in bonds last year, led by your area, the safest aspects of the credit markets. And then this year, they're behaving like equities. Does this bring in tourist flows and create more volatility just sort of inherently for the asset class for a longer period of time?
There's a big rotation going on in the market, Lisa, and that's a really good point. Bond investors, we brought a lot of tourist investors into the asset class as bond yields came down structurally over several years. What you're seeing is a very big rotation in terms of demand. Retail demand, we have seen a little bit of a pop early in the year, but where you see the biggest form of demand is coming from the institutional side. These are pensions, they're endowments, they're insurance companies, they're large institutional investors who buy bonds with very specific liabilities that they're trying to match against. This is where we see the greatest amount of demand. The other is just sort of globally, where is demand coming from? We've historically, or at least over the last several years, tremendous demand from overseas. That's pulling back as the dollar sort of weakens in here a little bit, but we're seeing a nice uptick from domestic investors. If you look at the pension industry, sort of funded plans are as high as they've ever been. So that sort of rotation from equities into bonds is a structural move that we're likely to see throughout the course of this year.
So let's put some numbers on this, George. Last year, investment grade corporate bonds in the U.S. lost 16% all in total return. So this year, could they gain 16%?
It's unlikely. I think the realistic sort of returns for, say, an investment grade bond over the course of the year, we would sort of pencil in conservatively sort of mid to maybe high single digits. So if you could claw back half that loss, there's a good probability that happens. 16% would be a massive recession, major drop in yields, and bond yields for corporates coming down as well. That's not our central case.
George, I don't mean on a pension basis or a CFA level 3 basis, but to our listeners and viewers, I believe we've had a great moderation. We've had a massive medical issue in COVID, in pandemic, and ginormous swings in what inflation will do. Have you adjusted a casual actuarial assumption that all of us need to assume? Do we need to save more because our total return over the next 10 or 20 all-spring years is going to be lower?
We think structurally, sort of returns more broadly are going to be lower. And it's as inflation's gone up, as you pointed out, we think inflation will stay higher structurally than what we saw over the last decade. On top of that, Fed policies moved up. It really means that, sort of the cost of capital is going to stay structurally higher, and that will keep sort of overarching returns lower, perhaps, than they've been. That goes back to the story about bonds. Why are you buying them? What can they do for you? If you're compounding your portfolio at, say, 4 to 8% a year, that's a very desirable sort of return level with relatively limited volatility. Our vol shock was last year. That volatility should come down as we move forward, and that will help your bond portfolio both be accretive to your overall wealth, help grow your wealth portfolio, but then also, as I mentioned, that buffer against other things we think comes back in vogue as we go through this year and into next.
George, I'm so glad you went there, because the volatility aspect is where I wanted to go. And Tom was asking me what the reading was over the weekend that I wanted to do. It was very much about, have we gone a little bit too far and gotten too complacent with this idea that we're not going to get volatility again in benchmark rates? How much are you watching the roll-off in the balance sheet for the Federal Reserve and the potential that they go beyond what the market is expecting, try to shock the market into perhaps a bit more of a tighter financial condition, and that this actually disrupts this thesis of a lack of volatility?
Well, I think it means that vol, again, it's been coming off the peak. So we had an extremely volatile year last year, as in all markets kind of repriced to this structural higher inflation environment. As that sort of that shock value of that experience comes down, vol comes down with it. So if the Fed is going to moderate its pace of rate hikes, that's a good thing from a vol perspective. We know that there's QT happening in the background, so that will add some vol. So vol will remain elevated. It will just not be at extreme levels like we've seen. That means risk premiums broadly speaking, have rallied, but they're not going to rally back to those extremely tight levels that we saw. Again, it all goes back to that increased sort of risk premium that's built into the market. As an investor, you can take advantage of that. Our view is that the economy is slowing, but more importantly, there's a massive rotation happening within the economy. Inflation is not universally a bad thing. Many companies, we just saw nominal growth last quarter, 9%. I mean, that's a pretty punchy economy. There are beneficiaries to that type of environment. As a bond investor, I can take advantage of the volatility, rotate my portfolio to focus on the winners. Nice bottom-up analysis and really sort of capture that yield as we go forward.
George, thank you so much. George Bory of Allspring, always informative, particularly on the bigger picture towards retirement. And, I'm sorry. As you know, I'm never going to retire. They got the surveillance casket out back. But Lisa, there's the Chancellor of the Exchequer before speaking with Anna Edwards, and he cuts to the social policy Mr. Bory was just talking about on retirees in the pandemic. He says to retirees, get back to work. Quote, I say Britain needs you. And we're going to see that in America, too. It's like, let's go, pandemic over, and anybody with gray hair and a bow tie can't retire.
Well, and it goes to the structurally longer inflationary push that goes beyond just pandemic spending, because if people are retiring, if people are pulling out of the workforce, well, then you've got a labor shortage, and you're seeing that across the board. And so how much does that keep inflation sustained? You know that I saw this story on the terminal this morning that people who work for central banks, the Fed and the ECB, are complaining that they're not getting wage increases in line with inflation. So even the central bank workers are saying, hey,
that's
wait a
part
second,
of the retirement
this is part of the
story.
issue. Yeah.
And it's part of it. There's a whole actuarial assumption that nobody thinks about this till they're 42. So you're years away from worrying about retirement. But the bottom line is we underplay this in the financial media. George Bory's living it at Allspring. This is a huge deal. I mean, as the Chancellor says, get back to work.
And if you don't
retire,
then all those central bank workers will say, wait a second, everyone else is getting wage increases. I want to get them too.
Email from London. John says, really? Okay, thank you, John. John Farrow coming up on Oil with Amrita Sen. Stay with us here, red and green on the screen. The VIX, 18.86.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The UK's Chancellor of the Exchequer, Jeremy Hunt, dismissed calls for tax cuts. In an exclusive interview with Bloomberg TV, Hunt said that sound money must also come first. He was asked about so-called green subsidies.
Well, we think that if we're going to have the transition to net zero, we should benefit from free and open trade between all the countries that share that ambition. But I don't think subsidy is necessarily the best way. I think what people want is creativity, innovation, ideas, a climate, a regulatory structure that encourages investment.
Hunt also pitched the UK as a hub for high-growth, high-tech industries and innovation. Well, it's been almost a year into an invasion that Vladimir Putin figured would be over within weeks. Now, Bloomberg's learned that the Russian president is planning a new offensive in Ukraine. He's also bracing his country for a conflict he expects to take years. The Kremlin wants to show its forces can regain the initiative after months of losing ground. The idea is to force Ukraine to agree to some kind of truce. Goldman Sachs warns that the next sanctions on Russian oil are likely to be more disruptive. The new penalties take effect next month. Among other things, they'll impact diesel fuel. Russian diesel exports account for 15% of global flows. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Refinery capacity is down about 8% relative to where it usually is this time of year, and that's putting some of that squeeze on gas prices. Perhaps more exporting of refined product from China and other exporters could help in that regard. But you do have to look at the refinery situation to understand the near-term movements in the gas price, which still, by the way, is down about $1.40 since its peak last summer.
Jared Bernstein there with the White House. Very important and a really sane voice on financial matters there on hydrocarbons. And right now, Lisa, a large hydrocarbon company reports. Fortress Worth reports.
Yeah, Chevron, after saying that they're going to buy back $75 billion of the shares today, reporting fourth quarter earnings are below expectations. Adjusted earnings per share in the fourth quarter, $4.09 versus $4.27. You do see a move marginally lower, 42 basis points lower, less than 0.5% after yesterday's nearly 5% gain. So perhaps this is a story of share buybacks and dividends exceeding any sort of slight disappointment at a time when fossil fuel is very much in the forefront.
I want to compare and contrast here upstream, downstream, and we're going to get to Amrita Sen with John Ferro in a moment, but upstream is the romance of going across the horizon and going out and finding a marginal barrel, 5.5 billion large, and you compare that with downstream, which is like getting it to your tank. Oil, 1.2 billion. That gives you the big oil balance between upstream and downstream.
But this also really kind of complicates the message for the White House, because the White House got really angry with Chevron. Remember that yesterday, saying, how can you invest in share buybacks? You should be investing more in production. And if they come out with disappointing earnings, perhaps they could say, look, we're doing what we think is right with the market and, bugger off.
The production, okay, if we could say that on radio, the production part of it, I get. I mean, take the money and run it into production. Why don't you do that? But there's a whole green issue, ESG issue, and there's also just the issue of is it just going to be a pure share buyback? The last 10 years, Chevron, 9.6% return per year. John Ferro, he's always upstream and downstream, the River Thames, moving from football match to football match. Fulham, I believe, is upstream, Lisa. Okay. And West Ham, Fulham is here, and West Ham is downstream. Did I get that right, John?
I guess just about, if you meant West London versus East London.
Yeah.
I think that's what you meant. But, Tom, I guess I'm trying to make a career out of translating what I think you mean. Tom Keene, thank you. Amrita Sen there, co-founder and head of research at Energy Aspects alongside me in London. Amrita, great to catch up with you.
Thanks.
It's fantastic.
Great to see you in person.
Tom just went through the Chevron numbers with Lisa. $75 billion buyback announced in the last couple of days. I think across a handful of firms, $200 billion of profits last year. It's not bad. Can you tell me whether those CapEx decisions have changed, and are they going to change anytime soon?
No, the answer is no, I think. And, Scott Sheffield said this as well, through and through. Regardless of where oil prices are, these companies are not particularly keen on investing. And dare I say, I don't think we can fault them, because investors don't want them to invest. Investors want them to be focused on ESG metrics, even with energy prices where they have been. And that's exactly what they're doing. They're giving back pretty much to shareholders, and whatever investment they can do is in green energy.
Well, let's talk about where energy prices have been. We had triple-digit crude with China locked down. If the US goes into recession, can we still have triple-digit crude?
I think so. I really believe this is Asia's year, with China reopening. Demand was down over 1.5 million barrels per day just because of, from China, right? Yes, we grew by over 2 million barrels per day last year. But when China opens up, all of Asia is going to go with it in terms of the effects we're going to see with travel, with exports. I think that is going to be more than enough to offset US recession. We already have US recession in our numbers.
One question we explored earlier this week was the commodity intensiveness of this China reopening. One person suggested to us they don't think it's going to be that intensive. Are you taking the other side of that?
Look, metals-wise, we've already seen a pretty big pickup, and I'm not an expert to comment on whether the metals intensity is going to be the same. But from an energy point of view, we are already starting to see them buy. Look, given how much refining they need to do and how much storage they're building on, I'm very happy to take the other side, that their imports are going to be up at least 1 million barrels per day year on.
You mentioned the supply backdrop. How vulnerable is the supply side of things coming into 2023?
For me, the fact that there is no SPR, we've released 220 million barrels last year. That was effectively the supply that came to the market. OPEC is kind of maintaining course right now. We are not far away from a big deficit. I think the deficit happens really in the summer, not right now. But right now, it's gasoline, it's diesel, things we pay for, incredibly tight. And it is going to be a very, very tight products market that translates into crude in the second half of the year.
I've sat through a week of optimism, constructive views about Europe and Europe escaping the worst of it through this winter. You're smiling, so let's build on it. Did Europe escape a bad winter because they got lucky with the weather, or because they fired up coal?
I think it's a bit of both. I really do think the weather helped, right? If it was as cold, I mean, this week hasn't been warm. This week has been relatively cold, but it's been in spurts. If it was a genuinely cold winter, I think Europe would have still been in a little bit of trouble. But yes, cold helped. People have changed behaviors, right? I mean, a lot more people are talking about we wear jumpers at home and keeping the temperatures down. That has definitely helped. But the reason I'm smiling is I also think European policymakers are probably being a little bit smug right now. We still have next winter to get through. I just don't think we should be like, OK, we've solved the problem.
Well, let's talk about that and whether that smugness is misplaced, if you want to call it that. Through last summer, we were building up storage, and we had the benefit of Nord Stream to build up some of that storage at reduced levels, at reduced capacity, I know. Can they repeat that act this year without Nord Stream? How on earth are they going to do that?
And with China reopening, because China's not an oil story only, it is going to be an LNG story as well. And I think that's where I come back to, look, yes, it's justified why prices have come off right now. But to expect these prices to remain for the rest of the year, that's where we would disagree.
You've got to forgive me for asking a calendar-based question, but I will ask one. When are people going to start caring? Because the front page that I've read throughout the whole of this week is sure it's cold, but Europe's escaped recession, Europe's escaped recession. When are the people that you talk to going to start caring about the things that you're talking about?
I really wish they already started caring about it, honestly, because, again, it becomes very short-sighted. And I also think it's too soon to say we are going to avoid a recession because industry doesn't come back that quickly. Yes, I absolutely don't think it's going to be a severe downturn. But we are. I mean, look at the layoffs that's already happening in the tech sector across US and Europe, by the way. It will have an impact on growth.
So will you say tough winter ahead for Europe this year? Regardless of where the weather might go, based on the fact that it's going to be tremendously difficult to build up storage in the same way they did in the last 6 months because there's no Nord Stream and China's reopening. Is that just the base case, tough winter ahead?
So I would say, yeah, for the next winter, not this winter. And it will depend a little bit on what happens with China and how much China buys. But our base case is that China is going to come back pretty strongly. So, yeah, look, again, we're not expecting a repeat of last year, but we would also very much caution that this is not going to be status quo forever.
Amrita, this was great to do this in person.
Thank you.
Fantastic. It's nice to see you. Amrita Sen there of Energy Aspects. TK, you heard it. I think that's a worry that a lot of people have. They are, yes, better off with the winter we've just had in Europe, but ultimately, can you repeat the act next winter?
And I think things have really changed here. Overnight, John, I assume you didn't see it. General Hodges, formerly with the U.S. Army with some real military experience on Europe, wrote a blistering article on the options Ukraine will have with tanks. So I think the military overlay changing with the new staffing of their material in Ukraine folds right into the energy story. As well.
Tom, I couldn't agree more. There was a real reluctance, TK, to provide these things 6 months ago. There was a worry that this would be seen as an escalatory step, and now we're doing that. And now there is a conversation taking place too, Tom, and I'd be looking forward to hearing what Richard Hart has got to say to you in a couple of hours' time about it. A conversation about maybe providing jets as well. I don't know where we are on that, but certainly we're taking steps in the wrong direction in the minds of many that perhaps this could escalate.
It seems to be the jet story, let's call it, in the next conversation as well. John Ferro in London this morning here, and again with futures. A little red on the screen, but we've seen this week. Lisa, to your great comments to George Borey of Allspring, I went back and I did a careful study while John was yammering away with Amrita Sen of the Bloomberg Total Return Index.
Yeah.
Almost a 4 standard deviation move down over a 3-decade look at the price of bonds. You know, huge move. Down 16%, and we've come up 5%, come up 6% as well. My word, there's a long way to go.
Which is the reason why people are looking at this as possibly income over a long term. The volatility has been tremendous. And even what we heard from George Borey, you're not going to get that 16% return this year. And it wouldn't even be full return if you got 16% to get all of the losses of last year back. So how much do people come back? How much new value has been unleashed? But what's the pain that people are ongoing and sitting on in terms of losses?
And that goes to what I talked to him about retirement, and frankly, the Chancellor of the Exchequer's comments about the retired who can't retire for any number of reasons or choose not to retire. That's the next dynamic.
Well, people are kind of hoping that that's the case because there have been a lot of people who've retired who are still spending, and people are concerned that that's created a real labor shortage.
We will see the inversion, really pretty substantial. Wednesday, I'm going to say negative 70 something, now negative 66 basis points. Yields higher 3.56% on the 10-year yield. Stay with us. This is Bloomberg.
look at what's happening with the consumer, which is the backbone of the U.S. economy, we are seeing a clear loss of momentum.
Further deterioration in the labor market, we're starting to obviously get a flavor of that.
The danger is we have to go higher in rates, and it lasts for longer than what the Fed is even looking for.
We don't think they're going to cut by the end of this year. We do think early 2024.
It's going to be a recession, but a mild recession, so it's a hard landing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro in London, Lisa Abramowicz and Tom Keene in New York. On a Friday to get to Fed Week next week, we readjust. Think about the weekend reading and the view forward. In the backdrop, the overwhelming reality, Lisa, is not stunning, that's not the right word, but just a good equity market pushing against the bears.
Even though you do have a really bifurcated picture of the haves and the have-nots from the earnings that are coming out. We saw yesterday from Visa and MasterCard, for example, spending is down. Consumers are spending less. Just now, American Express crossing, their earnings are up and their expectation is up for this year. So again, it's hard to find a cohesive picture at a time of such distortion.
I looked at the Apple dividend stream and share buyback stream. I'll get to that in a minute. I don't want to lose the flow of the program right now. But there's the headline, American Express to boost quarterly dividend by 15%. That doesn't sound like recession policy.
But then you look at an Intel and it looks like recession policy, and you look like a kitchen sinking of the whole affair. So at what point do you get a signal versus a noise? Who is the mainstream? Who is the zeitgeist at a time where you've got idiosyncratic stories that are telling such different narratives?
Colgate-Palmolive out as well with a little bit of a revenue beat. We'll get to that here in a moment. 'Cause our big problem here is we're so focused on like 12 names. Apple. Should we do Intel? It's a small cap.
Exactly. Well,
we're as guilty of this as anyone.
The big picture here is that people are feeling optimistic, not just about the U.S., but more so international. And the thing that really stands out to me is the consensus suddenly that Europe and emerging markets are going to outperform and can continue to, even though you've had a rip-roaring beginning of the year. That is the question that I have over the weekend. When do you know it's gone too far? When has that optimism run into a bit of a headwind of perhaps a reality that isn't as realistic?
And before the data check and the brief to get to our wonderful guest today, I'm looking at sterling, and as John has mentioned, 103 to 124, sterling ascendant, dollar weaker is a backdrop into February.
Is it about sterling or is it about the dollar? Is it about the dollar weakening and people kind of moving back as they look to get everything ahead? I mean, really, at what point do we have an understanding of what's priced in, especially with all the variables still out there, as you've been pointing out with oil and gas and the war in Ukraine?
Red and green on the screen with a good bull market we've had. VIX 23, breaking through 20, breaking through 19. The optimism of 18.88 on the VIX, and the yield space, higher yields. Two-year yield 4.22%. We mentioned the dollar. Brent crude, thank you, Emery, to send for wisdom with Mr. Ferro. $89 a barrel Brent crude.
Yeah, and we did just get Chevron and American Express earnings. We talked about Chevron and their $75 billion buyback. And as we look forward next week, we get Apple, Amazon, and Google all reporting on Thursday. Will that set a different tone? Will that set perhaps a reality check for the previous leadership of this market and what has been a leadership going at least so far this year? 8:30 a.m., the data dump, U.S. personal income spending and core PCE. Core PCE, really important to understand how much the Fed can move away from perhaps a north of 5% Fed funds rate that a lot of people are expecting. Can they do a Bank of Canada, raise by 25 basis points and say, we're done? 10 a.m., we get University of Michigan sentiment survey. Do we start to feel a sentiment among the general population mimicking what we see with financial conditions, mimicking what we see with investors? And do people start to spend more, kind of creating this push-pull conundrum?
I mean, the divergence of claims is one statistic versus Michigan is another statistic. It's stunning. It's like two different worlds.
Well, the claims are not there. And people say it's a distortion. If you've got, packages, when you get laid off from a tech company, you're not going to get counted. But, there's something that's not adding up to real pain that some people say has already created a recession that's happened, and we can move on.
Real pain is going to Caen and stopping by Hermes at the Rue de la Croissant or whatever it's called.
He's talking about
and
Caen.
Dropping in Caen, whatever it is. I've never been there, folks. Anastasia Amoroso gets off the Gulf Stream and she's back from a private equity summit. Danny Berger was there. I'm sure you waved and chatted as well. What did you learn in the wonderful atmosphere of
Khan.
It's the Khan. Well, first of all,
Genghis Khan. What did you learn from Genghis Khan about private equity?
First of all, no private jets, no Gulfstream, but I did learn a lot about private equity, and specifically, I think a lot of people in the room felt like this is the year to commit. This is the year to commit to investing because this should finally be the year where we see a reset lower in private market valuations. I mean, Tom, if you look at a private market portfolio through the first half of last year, it was up 4%. The 60-40 was down 17%. Right. And so over the last few quarters, and especially in the next couple of quarters, we should start to see those valuations more meaningfully correct. And if you're a private equity investor, of course, if you're in existing portfolios, you're going to get those marks lower. But if you're just deploying new capital to work now, that means the net IRRs from the downturn years tended to be better for private equity. So for people entering the space, right, there is a reason to be optimistic.
Within your strategy at iCapital, and this goes for bonds and the guesstimate on stocks, but to keep it on Genghis Khan? Khan. Thank you. I'm learning. To keep it there, is there too much money chasing too few ideas? Are we drowning in money right now, drowning in cash?
Well, first of all, the dry powder for private equity and venture has come down. Some of it has been deployed. But I don't think, Tom, there's few opportunities. I mean, if you look at the market size of private markets, it is 5 times what is available in public markets. Having said that, if you looked at the valuation reset post-08 and post-2015, 2016, I don't know if we're going to get the same valuation reset because the dry powder relative to that point is certainly much higher. But I think one of the things that is likely to happen this year is last year the deals were not getting done at the tail end of the year because the bid-ask spread was very wide. The companies that were looking to raise funds didn't want to really take a haircut in valuations. And then private equity companies were looking for a deal and they were not getting it. But now that the last funding round has likely run out because it was raised in 2021, I think that's now the time where the deals will start getting done.
Tom raises a great point. There is so much cash still out there. There's all this undeployed capital, which raises this real issue. How do you know when the reset is enough? You say it's not going to be a reset like 2008 because of all of this money. Is the Fed not being successful draining the system of liquidity?
Well, I think they're trying hard, and at least I think they are being successful. First of all, you've seen a massive reset in the public market valuations. I mean, we have this cross-asset look at all the valuations in equities and rates and fixed income. And if you look at fixed income, it is reset to the cheapest valuations we had in 15 years. Not credit, but a lot of the rate side. If you look at equities, we're sort of middle of the road. But think about the opportunities, the valuations that really needed to come down. It's in software, it's in tech, it's in venture, and we have started to see a pretty meaningful reset there.
What about in private markets, though? Because a lot of it hasn't priced, right? It hasn't transacted, so we don't really know. Are we going to see more carnage that perhaps changes some of the optimism that people have now before they even see what that pain is?
So within private markets, there have been resets too. For example, if you look at venture, the reset needed to happen in late stage venture because the valuations have gone like this. And you're starting to see 30-40% markdowns in some of those valuations, and that's a good thing. The second place where the correction valuations is playing out in the secondaries market. If you think about all the institutional investors that have allocated to private equity, they have not over-allocated, but they've allocated a lot, and the private markets, the performance was double the S&P since 2020. So they now have to pare back those allocations, Tom, and as they do, and they sell the secondaries, they're starting to trade, those interests, private equity interests are starting to trade at a discount.
I'm busting your chops about Khan, and the truth is you're in an hour-and-a-half layover in DFW. Everybody's back to work in America. What's the spirit you see out there in America? Is the media overplaying the gloom that's out there?
Well, I do travel a lot, Tom, and now also domestically, internationally, and the spirit is, it is buoyant. I mean, you go through the airports, you go through the lounges. I mean, I think people are gainfully employed, and there's still wage growth to be had. And Lisa, we wonder, why is there not a softer path of retail sales? Because people are gainfully employed. And sure, there's some jobs that may be changing hands, but those layoffs are not resulting in higher unemployment.
Again, though, this makes me wonder how people can have such conviction that the Fed's going to just pause. I mean, honestly, if you take a look at what's being priced in and how much of the enthusiasm we've seen, that we've already had this immaculate disinflation is going to basically be cast some cold water. with exactly that resilience, that buoyancy that you're talking about?
There's two time horizons we should think about. The one going into next week, which I think the market is probably severely underpricing what the Fed may say. I think they are likely to be more hawkish. The Fed is talking about getting to 5% or higher. The markets, if you look at the Fed fund futures implied rates, they're not even getting as close to 5%. Yeah. So there seems to be a dichotomy there. Near term, I don't think the Fed is satisfied with the pullback in service inflation. Longer term, as you think about 6 months and below, I mean, we now have durable goods deflation on a month-over-month basis, and I think these layoffs will damp the sentiment on wage growth. So in 6 months' time, I suspect we're not going to be looking at 4.6% year-over-year wage growth. It'll be lower.
I got to do a surveillance correction.
Please.
Okay, Mrs. Keene emailed, and thank you, Mrs. Keene, for watching this morning. She says, "You moron, it's croissant, not croissant, the boulevard in Cannes." I said, "Rue de Croissant." And I was wrong. It's croissant.
They were croissants, but
she says my punishment is 4 days there in July at the Carlton. That's my punishment.
We're crying for you.
That will be all right.
That'll be all right. I did okay. Thank you for that surveillance correction. We needed that. It's croissant, not croissant. I'm learning every day.
Yeah. Okay. What's it called again? Just go quick.
Rue de la. Oh, the town.
Yeah.
Genghis Khan.
Yeah,
That's the only way I can remember
Great.
it. Seriously.
Nailed it.
Nailed it. I'm going to watch Grace Kelly movies all this weekend. Thank you so much. Anastasia Amoroso with us with important perspective there, and particularly, because, we make jokes about it, but a lot of our guests, including Anastasia, seriously on the road getting the pulse of what's out there. And I would suggest, Lisa, more optimistic than a lot of the gloom that was painted over the last, say, 6 weeks.
I feel like everyone's been optimistic. I feel like over the past 3-4 weeks, the optimism has just been really tangible. And a lot of it is because the circumstances have changed. The facts have changed with the weather and with China reopening. It has changed certain elements of the backdrop.
Enough people are emailing me in from Paris. Croisette, oh my word, I'm going down in flames here. Coming up, a really timely interview. This is Andrew Balls of PIMCO, her Chief Investment Officer. Terrific perspective on the continent of Europe with our Jonathan Ferro in London. Andrew Balls, we'll do that here in a bit. Stay with us. This is Bloomberg. Good morning.
Keeping you up to date with the news from around the world with the first word, I'm Lisa Mateo. There won't be a tax cut anytime soon in the UK. Chancellor of the Exchequer Jeremy Hunt spoke to Bloomberg TV today in an exclusive interview.
We don't have the headroom for major tax cuts, but if I was going to prioritise where I would like to see tax cuts, it would be business tax cuts. But what businesses want even more than lower taxes is stability. And inflation is a fundamental thread of instability in the economy. It's a worry for households, it stops them spending, and it puts off businesses from investing.
Hunt also pushed back against U.S. and European plans to subsidize green industry, which threatened to divert investment from the UK. Bloomberg's learned that Vladimir Putin is planning a new offensive in Ukraine. The Russian president is also preparing his country for a conflict with the U.S. and its allies that he expects to last for years. The Kremlin wants to show its forces can regain the initiative after months of losing ground. It's hoping to force Ukraine and its backers to agree to some kind of truce. The International Monetary Fund is considering an aid package for Ukraine worth as much as $16 billion. Bloomberg sources say there are still a number of conditions, including endorsement from the Group of 7 nations. Ukraine's government would also need to commit to a series of policies. Bloomberg reports that Japan and the Netherlands will join the U.S. in limiting China's access to semiconductor machinery. The alliance is aimed at undercutting Beijing's ambitions to build its own chip capabilities. U.S., Dutch, and Japanese officials are set to conclude talks as soon as today. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Economic growth is up, stronger than expert expected at 2.9%. We're growing. Jobs are the highest in American number and the highest in American history. And wages are up, and they're growing faster than inflation.
The President of the United States there talking up where we are on inflation, and it is disinflation. That is a theme for us. Into next week, we're beginning to put together our Federal Reserve coverage. Look for that next week. It's February 1, right?
Yes.
February 1. We're going to have a Fed meeting, and it's going to be really interesting. 50 basis points. Of course, many people nudging to 25. Am I right on that? The consensus now is 25 beats?
Yeah, pretty much. It would be a shocker to markets if they went 50 at this point.
Lisa Abramowicz and Tom Keene in New York. John Farrow in London with some good conversations coming up this morning. Red and green on the screen. Headline, the VIX 18.84, and we are ever more accommodative on the Bloomberg Financial Conditions Index, 0.35 positive. Accommodative standard deviation. Right now, we're going to look at wars in Europe and maybe wars within the Republican Party. Maria Tadeo joins from Europe, and Anne-Marie Horton is, of course, our Bloomberg Washington correspondent. Anne-Marie, I guess it's a backstory if you're not in the GOP, but there's a Republican soiree today and vote. And making headlines is the governor from Florida who says, look, it was a substandard 2020, and 2022. What is the level of anti-Trump as the Republicans gather?
Well, I think these comments coming from Governor DeSantis to a conservative influencer, basically two things. One, he's showing that he is putting himself up on this national stage to be a really impactful voice when it comes to who's going to be the head of the RNC. But also he's saying that they need new blood. He wants a new challenger to Ronna McDaniel, and that is Harmeet Dillon, this individual he's backing. And he says this is because, as you outlined, they were not able to deliver this red wave that they forecast in the midterm elections. And he even goes back and says there's other elections we had failed. Also, we should note that Ms. McDaniel, she was promoted by the former President Trump. And what you hear from her challenger is that in the president of this RNC soiree, as you call it, Tom, and this debate on who's going to lead it, if you lose an election, you step down.
What's so important here is that's maybe the war in the Republican Party, but I think off the radar for Americans on this Friday is the war in Ukraine. And Maria Tadeo reporting this morning from Brussels. Maria, I want to just cut to the chase. Each general in America is different. And Ben Hodges is the guy that was in continental Europe, let's call it in Germany, worried about tactical warfare, including tanks in Europe. His comments are stunning on the reach of Kyiv to go after Crimea. Is that even feasible?
Well, if you ask the Ukrainians, they will tell you, Tom, and this we really need to highlight, that this will not get solved. This war will not be resolved in a way that they can agree with and agree to the terms if the Crimea question isn't settled. And Tom, we agree when you talk to officials. There's a public statement, and then there's, of course, the off-the-record stuff they'll tell you behind the scenes. The one thing that I always found is very striking when it comes to Ukrainians is that they will tell you on and off the record they believe and really believe this Crimea belongs to Ukraine, and this question has to get solved and resolved. If they do not get Crimea back, it will be a pause, but it will not resolve the question of the war. Now they feel with the tanks, this discourse of offensive, defensive weapons, that they can reclaim them back. The question is, what about their allies? Will they agree to this? Crimea is a very sensitive subject for Europeans.
I mean, Lisa, the pedigree of our generals, nobody ever talks about it. They talk about when they go to the Pentagon and they got all the brass on their shoulders. How about a young infantry officer who becomes the executive officer #2 for the 2nd Armored Division Forward in Germany? That was a young Ben Hodges years ago.
Someone who very much understands the logistics of war, not just the theory behind it and the gamesmanship. And Maria, I want to go to this issue as we see Vladimir Putin doubling down, even if he can't necessarily win outright. And you see the U.S. and Germany lining up with tanks and with other ammunition for Ukraine. What is the risk, and how much has it escalated, of some sort of great escalation here?
Look, it depends who you ask. If you look at what the Polish Prime Minister Morawiecki will tell you is that a lot of this is bluff and that Russia feeds off that fear. If you show you're not scared of that potential escalation, then of course it will backtrack and they will take a different tone. If you show you're scared, that's when Russia escalates to escalate, hoping that it's the West that will try to make a move and de-escalate. It really depends on who you ask. But I think beyond that, this has been a monumental week from the European perspective. A year ago, remember, we were talking about whether or not there would be an invasion. Germany was ready to send helmets. That was the only thing they were ready to send. This week, a major shift in that coalition. They now have sent the Leopards. This is a massive change in not just the German policy, but also the European. The scale of the action taken is something that a year ago, frankly, not a lot of people would have believed.
And Anne-Marie, in the United States, the situation has changed on the margins in terms of support for some of these efforts. There has been a lot of focus on potential corruption. There have been the firings of a number of heads over in Ukraine. But there is a voice, a minority that's gaining steam, pushing back against some of the aid. How much is this becoming more mainstream versus still on the fringes?
Well, I think these discussions are going to be a little bit more mainstream in terms of that they will have a seat at the table in the discussions, because when you have the debt ceiling debate and the fact that Republicans want to talk about spending extractions for that, defense spending may come up and spending to Ukraine may come up, because this is something that we've heard from the ultra-right on the Republican side and also some on the left. Not that they don't want to support Ukraine and send aid, they just want there to be potential openings for peace talks. But what you have seen this week is what Maria was talking about with Germany, just sending helmets, now sending tanks. You also saw a reversal of policy from the United States. And what we hear from Ukraine is now they're asking for those long-range missiles, which, to Tom's point, General Hodges says is the only way to capture Crimea. And he says capturing Crimea is really the only way Putin can get out of Ukraine fully. Crimea is always going to be in for Russia to have influence in Ukrainian society and Ukraine's economy.
Anne-Marie Horton, thank you so much. Ladies, lovely to have you back together again. And Maria Tadeo in Brussels is, well, I'm sorry, Lisa, I think this is off the American radar. Ben Hodges lights it up here this morning. And I will just say it as clearly as I can. All of a sudden, this is like war, like from our history books. It's not distant anymore.
Which I think is something that we get lost in, because the number of casualties are also reminiscent of a war from another era. It isn't the usual kind of tactical kinds of bombings and things that are less significant or less sort of hand-to-hand combat in the same kind of way as we're seeing over in Ukraine.
Double surveillance correction? As we go block to block.
What, that Maria was in London?
Maria was in London.
Yeah.
I didn't pronounce it correctly. I got croissant wrong. I think I can get Queen Victoria Street right, but she's in London.
Well, if you're calling it London, you're going to have some other problems. Maybe some bigger problems.
or whatever. Maria today on Anne-Marie Horton with us. Let's talk about the data. Which part of this, equities, bonds, currencies, commodities, floats your boat this morning?
The stock market's been really fascinating to me. The fact that every day we seem to start on a
earnings,
soft
you've done
note.
a great job.
Well, thank you. But we start on a soft note, and then by the end of the day, everyone's rip-roaring excited. So how much can we continue with that, considering that we do get some stories that are not that great? I mean, honestly, what we got out of Intel yesterday, I can't say enough. Yes, this is a PC. This is a personal computer story. But this is also a company that hasn't kept pace with the innovation. You have others like that. Have you fully reset for some of those companies with the sell-off that we saw last year?
As the consumers are just pulling back, Amex forecasts revenue surge after record cardholder spending. That's from Reto, keeper of the Amex.
How much?
He's just sent me a note on this.
How many people who have Amexes, though, it's all for the Delta Lounge?
Oh, well,
I mean, seriously, how many people? I'm not kidding. You can ask.
Bloomberg News
Survey.
reports Reto Gregori, Amex forecasts a revenue surge. Tom, cut it out. Stay with us. This is Bloomberg. Bloomberg Surveillance. Good morning, everyone. John Ferro in London. I'm Tom Keene. Well, is he in London or is he on his way to Manchester?
London. I think he's in Cannes, Genghis Khan.
Yeah.
No, he's in London.
If you paint with Ferro and Ball paint, then you have to say London. That's how it works.
Nobody says that.
That's a Saturday Night Live thing. Good morning, everyone. It's Friday morning live here at Bloomberg with futures at -11 right now. There's a lot of interesting things going on. Some real nuances of accommodation is seen with the Bloomberg Financial Conditions Index. And Lisa, I'm sorry, this is coming like a train. Brent crude, 88.65. That's a story underneath the story this morning.
And you're seeing that in gasoline prices, and you're seeing that with this question around how much that's going to fuel the ongoing rally that we've seen in energy stocks, with a lot of people saying we're just seeing the beginning of what happens with China coming back online.
Yen off the radar today, and a lot of thoughtful notes into the weekend about thinking about Japan within a Pacific and a global sphere as well. That's a source of reading this weekend is what are the ramifications of 125, 120 strong yen, the flows, what inflation means for the people of Japan and their behavior as you look out to the Pacific Rim. That's another mystery into this year.
As well as what the Bank of Japan will do. Did you see the IMF come out and say we strongly recommend that the Bank of Japan normalize their interest rate policy? And everyone said, thank you, IMF. I think a lot of people are arguing for the same.
Just beginning to think about the spring meetings of the IMF. Will, of course, have some leadership there, we hope, as well.
Let's get some specific names because this hasn't been all about
season.
earnings.
Let's dive into it.
Let's dive in.
For the next hour with Lisa.
we haven't really gone deep into Intel, but I keep looking at 10% drop pre-market, and it's not necessarily dragging down everything with it. You are seeing a bit of a sell-off in Micron and Qualcomm and the other chip makers, but Intel is a specific story that has to do with PCs and the lack of demand there. They gave one of their worst ever quarterly forecasts, partly because of the personal computer sales. You say, you think it's because it's broader?
I don't buy it. Right now, they are 54% off their 2020 peak. This is about the slowdown, the granularity you're talking about. They'd love to say quarter to quarter, baloney. They're getting their clock cleaned on innovation and on technology with the Intel 4 debacle. AMD's cleaning their clock. That's my amateur take.
You're not. A lot of people would agree with you, as well as a number of in-house chip makers. I'm thinking Apple. I'm looking at Hasbro, also the toy maker, saying that it's going to cut about 15% of its workforce after a disappointing holiday shopping season, perhaps because all kids just use their devices and don't actually play with real toys anymore. But I am wondering whether, this is sort of the zeitgeist, as to use your word, Tom, shifting out into a broadening of some of the job cuts that we see. BuzzFeed with a similar tone. Those shares popping by about 30% because they said that they were going to replace a lot of their reporters with ChatGPT and other artificial intelligence.
Help me with this. This is like Paul Sweeney land. We're going to do it with Bramo right now. BuzzFeed's, let's be collegial. They bought me drinks once at the Piano Bar in Davos, which was lovely. BuzzFeed has been struggling, right?
Yeah.
So what are they going to do, lay off journalists and do ChatGPT journalism?
They're going to personalize certain posts for people and quizzes and some of the content that they put out using some of the artificial intelligence. The reason why I find this interesting, BuzzFeed is its own story, but there's a broader question of what ChatGPT and artificial intelligence can do. Did you see that ChatGPT just passed the bar somewhere? I mean, the bar exam.
They passed the medical national boards, which I tell people is the equivalent, like the CFA. They passed all 3 levels.
It just,
barely.
Again, am I going to be replaced by ChatGPT? And I say this, if it could do a better job, great. But there's this issue of, what is this going to do to workforces in a new way that perhaps hasn't been established going forward?
Got anything else?
That's it. That's what I'm looking at today.
That's it? Okay, well, there we are.
I can keep going if you want me to.
Well, give me one more. I mean,
Amex. Let's go to Amex. Because
Amex,
I think Amex is such a different story than Visa and MasterCard. Yes. Visa and MasterCard see a slowdown in spending. Amex seeing an earnings per share forecast this year, it's going to beat expectations. And I was joking that, how much of this is the Delta Lounge? But if you go and you see the lines lining up, how many people...
Never seen lines bigger. Never, ever.
It's an agreement, and it works for both of them. It drags in customers to American Express, and for Delta, they make billions of dollars.
American Express, their earnings. We'll continue this soiree next week with tech earnings as well. When she speaks, the fixed income world just simply stops. It is the heritage of Société Générale. They own the high ground of French math and derivative science. Subrata Rajappa joins us this morning. Subrata, help me. Let's go SocGen derivatives right now, which is calculus, which is rates of change. What's the rate of change story in the bond space this January as we see a bull equity market?
So the biggest rate of change was at the end of the year coming into this year. We haven't really seen bonds move meaningfully higher or lower from around the 3.5% level in 10-year yields. So for the most part, we seem to be kind of stuck here. Part of the reason is because fundamentally bonds look rich relative to fundamentals. And then you have a story where there's just a tremendous amount of demand for bonds. You look at the auction stats for this week, we saw very, very strong demand, from bonds from a variety of investors. So the cash that's in the sidelines is being put to work in the bond market.
I totally agree. And we've spent a lot of time this week, folks, on issuance ideas. If there's a shortage of bonds, that's what Sir John Templeton would have said years ago. What happens to yield over the space of this year?
I don't think that there's a shortage of bonds. There's going to be a decent amount of issuance coming from, corporate bond world. We are seeing a lot of issuance in treasuries. If anything, our call going into the spring timeframe was that the Treasury will increase its coupon issuance sizes because deficits are continuing to rise. I mean, that, of course, we'll have to wait and see because of the debt ceiling. But broadly speaking, I think there's a decent amount of supply coming into bonds, not just in the U.S. and in the corporate bond world, but also in Europe in the first quarter. So there's a lot of bonds that out there to be bought. And that's why we were expecting perhaps a modestly higher yields for the market to be able to take down that additional supply. But that's not the case. It's just tremendous amount of demand, and people are willing to lop up bonds, 10-year yields around 3.5%.
Subhadra, how long will this last, this rally, this optimism that you see pervading every asset class?
The data for the most part has been mixed, but on the positive side, you look at the data from yesterday that we got for the fourth quarter GDP, there's a decent amount of momentum going into the fourth quarter. And you're looking at an employment picture that's still extraordinarily strong, even though you're getting a lot of news about layoffs in the tech sector. Look at initial jobless claims yesterday. It was very, very low. That tends to be a very good leading indicator of the jobs market. So in this sort of environment, the market is actually, in my view, underpricing the risk of hikes for this year. We're looking at perhaps 2 hikes being priced in for the first half of the year, and then a cut being priced in as early as July or September of this year, which, that sort of trajectory doesn't make any sense in an environment where inflation is expected to remain high and sticky. I mean, look at what happened in Japan. I mean, we saw, an outsized print, relative to consensus on inflation. So there's always a possibility that, we do get those sort of volatile inflation prints, and the market has to respond, and the Fed has to respond and as well.
So what's the read-through to markets? What kind of disruption will there be if the Fed surprises to the upside, perhaps on a 50 basis point rate hike next week, but does indicate that they're going to go further than a lot of people are currently pricing in? How disruptive is it?
It will be disruptive. That's why I think that the Fed typically tends to stick with the market pricing. If the market's not fully priced, they'll find ways to communicate the fact that they're going to be delivering more than what the market's pricing in, and then the market will adjust. But broadly speaking, I think that, 25 basis point rate hike at next week's meeting makes sense. And then, another 25 basis points in subsequent meetings. But I just don't see them stopping or pausing anytime soon, like the Bank of Canada suggested they will at this week's meeting.
So then how does the dollar play into this? Because that might be actually a very different story than what people are pricing in there.
Yeah, I mean, I think the dollar's come off its very lofty levels. Broadly speaking, you're looking at the dollar versus, say, the euro. You look at the ECB. The ECB is poised to hike rates for the remainder of the year. Our economists are expecting that the ECB will raise its deposit rates up to 3.75%. The market's underpricing that level as well. So broadly speaking, at least versus the euro, I think that the dollar could come under a little bit of pressure. The Bank of Japan as well is starting to adjust its YCC. So I think the dollar is definitely peaked. I don't see a precipitous decline, but a gradual decline as other central banks catch up on the policy front.
Subrata, thank you so much. Subrata Rajappa with us, with Societe Generale. I was shaking my head there as she's talking about that. I have to go back to Maynard Keynes' paraphrase, when the facts change, I change. What are these central bankers going to do amid a legit trend of disinflation if that occurs?
Well, they will
They're
adjust.
going to be steadfast and just raise rates?
I wish that people on radio could see that. Charge forward kind of motion of yours.
Monsieur Macron,
yeah, exactly.
He's not going to be in Cannes. He's going to be in Paris. He's going to call up Madame Lagarde and say, what? And mon Dieu.
Well, this is the reason why the market's betting against the Fed and the ECB, but more the Fed, not the ECB, saying that you're not going to be able to do it because the facts are going to change and you just haven't realized it yet. So I think you're right. And that's what a lot of people are betting on.
What's important here, futures have deteriorated a little bit, -14 right now. What's important here, folks, is we get set for the weekend and the Fed week next week with our Fed show. It's on Wednesday, right?
Yes, correct. It's always on Wednesday. Always, yes.
I didn't know that.
Tuesday's when it begins. Wednesdays when it
It's Surveillance Correction Friday. We're just loading the boat. Bramo down in flames. Thank you, Taylor. She was in a law school library. I didn't know law school libraries were open at this ungodly hour. Anyways, Taylor, thank you for emailing in and telling us that GPT passed a law exam, like a class exam, some big class
not
exam.
the bar exam.
Not the bar exam. Taylor,
thank you
so much for correcting us.
Oh, I appreciate that.
Although a law school library at this hour.
My favorite part about this, I actually Googled when I was slapped down for my mistake, and evidently that ChatGPT did pass a law exam, but the average was C+ versus the average of other students, which is B+.
This is important because it was the same with the doctor's boards. And it's a barely pass.
Yeah.
I don't know what that means, but do you want your kids playing with ChatGPT? I think
a lot of people kids are using it for their exams and using it for their essays. It's been a real issue.
God, it's un-American.
Actually, something like that.
I never use the Cliff Notes.
I was about to say.
Keeping you up to date with the news from around the world with the first word, I'm Lisa Mateo. The UK's Chancellor of the Exchequer is dismissing calls for tax cuts. In an exclusive interview, Jeremy Hunt told Bloomberg TV, quote, "We don't have the headroom." He also pitched Britain as a hub for high-tech industries and innovation.
I think we have the opportunity with our universities, our financial services, and our technology strengths to be a Silicon Valley.
Meanwhile, Hunt also pushed back against U.S. and European plans to subsidize green industry, which threatened to divert investment from the U.K. Well, it's been almost a year into an invasion that Vladimir Putin figured would be over within weeks. Now Bloomberg's learned that the Russian president is planning a new offensive in Ukraine. He's also bracing his country for a conflict he expects to take years. The Kremlin wants to show its forces can regain the initiative after months of losing ground. The idea is to force Ukraine to agree to some kind of truce. Bloomberg sources say House Republicans are considering a short-term extension of the federal debt ceiling until September 30th. And that would give them more time to resolve an impasse with Democrats. But it's not clear if the Democrat-controlled Senate would agree. For now, accounting maneuvers could prevent reaching the limit until July or later. And more losses for Asia's richest man. The sell-off in Gautam Adani's corporate empire accelerated on Friday, erasing more than $50 billion of market value in less than 2 sessions. The fallout from a report by Hindenburg Research has investors keeping a close eye on the $2.5 billion share sale by Adani Enterprises. The Adani Group disputes Hindenburg's allegations of corporate malpractice. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
I think there's still that next hurdle for the market to get through, which is what is, I believe, more downward adjustments to at least the first half of 2023 calendar assumptions, both top line estimates as well as bottom line, which means further compression in margins.
Huge response to Liz Ann Saunders of Charles Schwab a few days ago, I should say. She was really on fire there about this odd earnings season. Lisa, to me, and Julian Emanuel at Evercore ISI will sum this up beautifully on Monday. Looking forward to that note. But I've never seen an earnings season where there's a mystery to the now and an even greater mystery out a conference call. Nobody's looking out to Q3. Nobody can get there.
I love the discussion around Intel was sort of, they're kitchen sinking it. So can we say that it's not going to get this bad and that it's actually, this is the tenor of conversation, the benefit of the doubt that a lot of people are giving companies.
The benefit of surveillance is we're always spinning forward. We're going to do that through the weekend reading into important technology earnings next week. We're going to do that and focus on what I usually hate to focus on, Facebook. We'll do that here in a bit. But right now, Mandeep Singh, Senior Technology Analyst, Bloomberg Intelligence. And Mandeep, I've just got to take all of your heritage and your history. I don't buy the short-termism analysis of Intel. They blew it in innovation, in Intel 4 technology, in 7-nanometer, blah, blah, blah. How does Apple, AMD, and the others avoid being the next Intel?
Well, so clearly there is a share shift going on, and I think the names that you mentioned are taking share from Intel. I think the benefit of doubt that people are giving to Intel right now is PC market is really in a bad shape. You're seeing, 30% decline in volume. And if Intel's client segment revenue fell 36%, yes, there is some pricing pressure, and they're dumping as much as they can on the channel inventory. But at the end of the day, the PC market is bad and it will rebound. The problem that I see for Intel is not only they are losing share, they still haven't figured out the process node part when it comes to, just catching up with TSMC. And that is the part that worries me about, that 2 years after or 3 years after, can they recover? Because you need that process node parity.
I want you, I'm saying this with immense respect, Mandeep, for your industry expertise. From an electrical engineering standpoint or operational research, whatever, the fact is Intel blew it. That's irrefutable. How does Apple, with an A13 Bionic chip, how do they not become Intel 5 or 10 or 15 years from now?
Well, so that's where you have to keep innovating, and you need that semiconductor lead when it comes to the manufacturing side of it. Remember, Intel manufactures its own chips, and it's the largest manufacturer, and it is behind in terms of, the technology needed to manufacture the latest cutting-edge chips. So that's where Apple can go to whoever they want. They could come back to Intel if Intel catches up to TSMC. But right now, Intel is behind in terms of manufacturing, and that's why I feel the fabless chip companies have an advantage. They can go to whoever they want in terms of manufacturing, who has the lead. And that's what Intel needs to do because they are the largest chip manufacturer here in the U.S.
Mandeep, help us understand the signal from the idiosyncratic story. What's the signal here in terms of demand for certain devices, perhaps personal computers versus particular devices, Apple, or on a broader level, just consumers and cloud spending, i.e. Amazon next week?
Yeah, so look, I think PCs as a percent of overall consumer devices is going down. There is no doubt. That's what you see in Intel's share is PCs are not that important anymore. It's smartphones and other type of devices going forward. And that's the problem that Intel has to solve for is they have to expand their industry exposure to autos. I mean, they have mobilized a segment, but they have to do it at a much bigger scale, as well as industrials and other parts of the market where they can use their chips. PCs are shrinking, and I think that's the other thing that Intel needs to focus on, that they need to expand.
As we look forward to next week, we have seen some motley pictures with respect to cloud spending, and I'm curious what the signal is from Amazon saying that they're going to sell Bay Area offices as they look to raise money. They are cutting some of the staff. How much is tied to cloud computing, one of the main drivers of growth that we have seen underpinning big tech in the past couple of years?
I mean, the way I look at it, Lisa, the amount of data is growing around us. And to process that data, you need computing capacity. And that's where I do think even if we run into a temporary pause, which I do expect for the next couple of quarters, things will rebound. You will need more cloud capacity. You will need more semiconductors and chips, but you won't need CPUs. And that's the other big difference. The world is going to custom chips. That's what Apple has shown us, and you're going to need more of that.
Mandeep, I got to get into next week. And the fact is, I'm stunned, folks. I just did this math on the Bloomberg, and I never would have guessed this. Talk about a face plant from Facebook. The Intel drawdown from 3 or 4 years ago is a negative 54%. Meta, it's like can't.
Are you kidding?
Meta?
It's not the cheese. It's not like you put it on bread. Yeah, like Meta. Put some Meta on your tomatoes and cucumbers.
Intel is down 54%, and Velveeta's down 60%. When is Zuckerberg going to wake up and realize he's done an Intel? What are you going to listen for in Meta earnings next week? With a stock with a drawdown of 60%.
I mean, although it has rebounded 50% from its lows in October. So I guess you can look at the time series in different ways, but you're right. It is down 60% from its highs. And look, at the end of the day, with social media companies, it's about engagement. And the fact that they're losing engagement on the Core Blue app, Instagram also seems to be losing engagement. And then you have an ad pricing headwind for pretty much the entire digital ad vendors. That is where the focus will be on engagement. If they can turn that around, catch up to TikTok, really get off, the issues they have had with Apple's privacy changes, I think those are the key points for the near term. And then beyond that, the VR strategy will come into play. How much losses can they afford, for the next 2 or 3 years when it comes to their Reality Labs ambition?
Well, next week, we are so advantaged, and we hope all of you on Bloomberg Radio and Television are advantaged with Mandeep Singh and Anurag Rana from Bloomberg Intelligence on the tech space. And I do note Mark Gurman's industry-leading reporting for Bloomberg News on Apple as well. PR from Kraft Foods just emailed and said, we are the product of Velveeta.
Not Meta. Put some Meta on here with that.
Thank you, Kraft, for that announcement.
Thanks for that cooking
Not
lesson.
that I
I
would
appreciate
have
it.
any familiarity
Exactly.
with Velveeta. Did you have Velveeta cheese in your refrigerator as a child?
No, I did not. I mean, no. But I did have Kraft macaroni and cheese after school with my brother. We'd pour 2 boxes in, and we'd take 2 spoons, and we would eat it before dinner, and that would be a snack.
That would be a snack.
Yeah, exactly.
That's
yes. Look, I think with all the earnings that are coming up next week, this to me is going to be the true test, the sort of question of what narrative we can actually sell heading into the remainder of the year. In some ways, tech is going to set that narrative because tech has been the main driver of some of the gains that we keep seeing. And if that fades, what's going to pick up that slack, at least in the near term?
Dan Ives, who joined us this week, and I get it. Ives is like a piñata because, he's the uber bull on technology and he's hugely visible within the financial media. But the reason is he's deserved to do that because he's pounded out Excel spreadsheets. And his basic take this morning into next week, look at what they're saying. Like Microsoft, numbers, up they go. They crater over the worry. And then the stock, just in the last couple days, has clawed back to some sense of optimism because of their scale, their level. Yeah, they're nicely above where they were before earnings. I'm going to call it 242 down to 232, down $10, and up they go, closing 248. That's the Dan Ives approach that we're seeing.
And that's the reason why some people are saying that a number of these tech companies are going to do the kitchen sink. They're going to lay people off, people who they perhaps don't even need, but it's a good excuse to cull the herd. And we got one viewer writing in, unfortunately, Intel seems to have multiple kitchens and many kitchen sinks to go at. So,
that's just failed management. When everybody starts talking about kitchen sink, all my radar goes up. That's all there is. They're free cash flow negative.
How much bad news can you put out there is sort of the question. We also got a correction, another surveillance correction, because we're doing really well today.
Where's Ferro?
We're just crushing it. He's going to come save us. That Velveeta doesn't need to be in the refrigerator, and that's why you had none in your refrigerator, because it's stabilized, and it's probably not really related to anything that other people would identify as food.
I have a memory of Jif like peanut butter.
Oh, I had Jif.
Peanut butter
Yeah.
and Velveeta was a way.
You had an amazing childhood, Tom.
Get to dinner. It was a scarred childhood, to say the least. Coming up, Ferro will save us. John Ferro and Andrew Balls, must watch, must listen. Good morning.
I think there is going to be some significant aspects of pent-up demand that are going to start showing.
This is about being active and taking advantage of opportunities again after last year.
The bigger question is, are we able to maintain that momentum as we turn the calendar page? And most of the data suggests that we do not.
The Fed will deliver a slowdown in the economy. It will deliver a loosening in the labour market, but it's how quickly it can do that and whether or not it wants to ease back this year.
I don't think we're out of the woods yet, but I think we're going through that bottoming process.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It was the earnings. It is the U.S. economic data. Good morning. This is Bloomberg Surveillance on Bloomberg Television and Bloomberg Radio. Tom Keene here in New York, Jonathan Ferro in London. I'm Lisa Abramowicz, 30 minutes away from a complete shift in narrative, potentially with core PCE income and spending.
Thank you so much for bringing this up. We have been amiss here, buried in earnings and looking at the collapse of Intel and such. We have a huge earning dump here coming at 8:30 and then on to 10 o'clock. And John Ferro, Lisa, has been ahead of me on this. I'm not a fan of confidence statistics. I just, I'm posh about it. I'm like,
It's because they didn't call
I don't want to do it.
How do you feel about Jiffy?
Exactly. But I'm looking at Michigan sentiment and Michigan 5 and 10 year forward inflation expectations, and that's big data this morning.
We've been remarkably Fed-free because we've been focused on the earnings, on the actual tangible day-to-day that the companies that have been reporting reflect, and yet the conversation will shift. It is the quiet period ahead of next Wednesday.
Thank God for that.
But the conversation may shift if you get core PCE that comes in above expectations. That is the key metric that this Federal Reserve does look at.
Well, it's going to be the mystery, and to me the mystery is economic growth. We're going to do that with Andrew Balls here in a moment with John in London. But there's a basic idea of central banks that have a plan, and will they be derailed by some form of lesser animal spirit, nominal GDP, and some form of disinflation? On a Friday morning, I got an 88.46 Brent crude, up $1, up 1.1%, getting near $90 a barrel. I don't know how you get disinflation with $90 Brent crude.
This is the tension right now. Don't fight the Fed. The mantra for a decade all of a sudden is fight the Fed because they're wrong, because they're not looking at the data that we're looking at. And that's what you're seeing with an easing in financial conditions, moderately tighter, I guess, on the margins, financial conditions, at least for now, if you look at the equities. And they are just marginally lower, but who knows what happens come by 4 p.m. today, because it seems like everything just bleeds higher.
Just lifts at 10 a.m.
Exactly. 40 basis points lower, 40.59 on the S&P. Honestly, the dollar strength that you start seeing come back, how much and how sustainable is it? Are we seeing the end of the dollar losses? Euro 108.60, still kind of stasis there, down about 0.3%. And that 10-year yield just marginally up, but it's been around 3.5%, pretty stably, pretty consistently throughout the past couple of weeks.
I heard that from Subrata Rajappa at Societe Generale as well. There's just a churn within the bond market. And I guess at the end of the day, I'm looking at the Bloomberg Financial Conditions Index, which did move this week and moved out to new accommodation away from where Chairman Powell wants it to be.
Let's get, you mentioned Andrew Balls, the head of fixed income for globally for PIMCO, over with Jonathan Ferro. John, I do wonder, though, how much people are going to start talking a little bit more about the don't fight the Fed, fight the Fed, because the Fed is wrong.
Well, let's talk about that right now. Andrew Balls at PIMCO alongside me. Lisa, thank you for that. Andrew, welcome to the programme. You put out an outlook recently with Tiffany Wilding. I think it was strained markets, strong bonds. We talk about a strained economy as well. You've got recession, I believe, in the US and in Europe as well. That Europe story here is starting to change. Why are you sticking with that call?
So the baseline is we'll have a recession in Europe, the US, the UK, number of countries now. The energy price situation is clearly a big positive in terms of the European outlook. And when you're thinking about the shallow recession versus a deep recession, then I think that there's definitely an improvement in the outlook. But given the financial conditions tightening that we have seen, more to come from the ECB. The baseline is for shallow recession in Europe, which is broadly what we think financial markets are pricing in as well.
What's the baseline for the United States now? You've got the Federal Reserve saying we're going to hold, and you've got the markets saying cut, cut, cut. Where are you on that?
So I think the Fed will go 2 more times and hold in March and wait and see. I mean, Powell has created the space for this, talking about the lags and so on. From our point of view, it's likely that the Fed will then be on hold for some time. When you think about markets, markets pricing in all sorts of scenarios. There's scenarios where the Fed will have to cut deeply if the recession is much deeper. But the most likely outcome, I think, is the Fed on hold. And we're still not out of the woods on inflation. A lot needs to go right on the inflation front, and so the risk which markets were very focused on last year has receded in terms of the Fed having to be a lot more unfriendly. But in terms of our positioning, we want to still pay a lot of attention to a scenario where inflation is stubbornly high, and you're going to have another period of Fed rate hikes, which clearly would be quite difficult in terms of risk assets, asset markets more generally.
Can we build on that a little bit and talk about the volatility in the bond market? The difficulty of last year was pricing the risk-free asset, the so-called risk-free asset, which makes it almost impossible to price the risk asset. This year, I think people were hoping for stability in Fed funds to really understand how to price everything else. If we have this gap right now between market expectations and what the Fed's trying to signal, can we resolve that gap? Can those two reconcile without getting another burst of bond volatility?
So I think so. I think a baseline of lower volatility compared with last year in fixed income markets is a very good one. I mean, it's a low bar because there was such a lot of volatility last year. And I think if over time markets price out those Fed rate cuts priced in for the second half of this year, I don't think that has to be very dramatic as you get more confidence in the shape of the recession and recovery this year. That seems perfectly plausible. The thing I think would be destabilizing, volatility inducing, would be if it looks like inflation is going to get stuck, core inflation, well above 2%, and you have to think about further rate hiking, the Fed causing more of a slowdown. So guard against that. The market pricing out the rate hikes, rate cuts in the second half of this year. I think that can happen in a lower volatility environment. And a lot of the strategies we'll do in our portfolios will A, be positioning for lower volatility in fixed income, but B, continuing to guard against the tail of worse macro outcomes or worse inflation outcomes.
So with that in mind, let's talk about the investment process at PIMCO. Just take us inside the investment committee, if you can. At the centre of it, at the core, you've got Fed funds, and then the further out you go, you've got all these circles. Can you just go through what these circles are and how far away you want to move away from the core of fixed income?
Yeah, so we talked about this in our outlook. It's a framework we've used for 10 years longer. At the center of global financial markets, you have the Fed and short and intermediate interest rates in the US, in the G10, and this is important. The stability there is important in terms of the causal effects on risk assets. So as you move out of our concentric circles into credit, into emerging markets, into equities. We think a prerequisite in asset allocation portfolios, say, of wanting to add more equity type risk is wanting to see that stability in global fixed income. And hopefully the restoration of more normal correlation between fixed income and risk assets and equity markets. So last year, you destabilized the center of that, the global asset markets, the Fed funds, rate expectations, big shift in terms of the Fed or Treasury yields in the US, very destabilizing for global equities. This year, we have the prospect of lower fixed income volatility and really good yields in terms of core fixed income, which is very important. So in our investment decision making, we're going to be emphasizing core fixed income, good yields that you can get there, and then be careful about the risk that you add. High quality investment grade credit makes sense, but we don't need to have lower quality credit, high yield. We can get good enough returns, we think, in the center this distribution, and continue to respect the fact that the recession risk is two ways. It could be better than our baseline, but it could be a lot worse as well.
This is another way of saying I don't like emerging markets right now. Can you build on that a little bit?
So I think we are scaling into emerging markets. We have emerging market positions, select FX positions, select local or dollar-based EM. So I think that it's going to depend on your asset allocation. But for us, I think at this stage, core fixed income, very good yields, above 5% for kind of core bond funds looks very attractive. As we get more confidence in terms of the shape of the recovery and or the path for the Fed, you can scale into EM over time. And EM was earlier hiking. They were earlier in the cycle. The yields are quite attractive. So I think there's good opportunities there.
I've got one final question for you. You're a bond guy, so naturally you're worried about something. Tom, Lisa and I have talked about this over the last couple of weeks. This is the third year of pandemic economics, and every single year we seem to have got it wrong, big time. Is there one thing that you're worried about right now that you think people might be getting wrong as we go into year 3 of this?
So the thing I am worried about is the possibility of higher inflation. So to relate it to the pandemic, longer time for healing in terms of all the disruptions we've had. And stubbornly high inflation that takes more from central banks to cure. It's not the baseline, but I think that is a big risk. And I think if you look at the last couple of years, no one's won any prizes for their inflation forecast during this period. And the baseline is the baseline, but you need to think very carefully about these risk cases. And the one which would worry me at night is stubbornly high inflation settling well above 2, 3 or 4% type core inflation, and if that happens, that's going to be very interesting in terms of financial markets and volatility.
Yeah, Andrew, always a clinic. Good to see you in person. Andrew Ball's there at PIMCO. TK, always a worry if you're a bond investor. There's one for you for the year ahead.
John Ferro, thank you so much. Appreciate that. Futures negative 14. Please stay with us. This is Bloomberg. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. There won't be a tax cut anytime soon in the UK. Chancellor of the Exchequer Jeremy Hunt spoke to Bloomberg TV today in an exclusive interview.
We don't have the headroom for major tax cuts, but if I was going to prioritise where I would like to see tax cuts, it would be business tax cuts. What businesses want even more than lower taxes is stability. And inflation is a fundamental thread of instability in the economy. It's a worry for households, it stops them spending, and it puts off businesses from investing.
Hunt also pushed back against U.S. and European plans to subsidize green industry, which threatened to divert investment from the UK. Bloomberg's learned that Vladimir Putin is planning a new offensive in Ukraine. The Russian president is also preparing his country for a conflict with the U.S. and its allies that he expects to last for years. The Kremlin wants to show its forces can regain the initiative after months of losing ground. It's hoping to force Ukraine and its backers to agree to some kind of truce. Bloomberg reports that Japan and the Netherlands will join the U.S. in limiting China's access to semiconductor machinery. The alliance is aimed at undercutting Beijing's ambitions to build its own chip capabilities. U.S., Dutch, and Japanese officials are set to conclude talks as soon as today. And Chevron posted a record profit for a full year thanks to surging commodity prices and domestic oil production. That generated unprecedented cash flow that will help pay for a mammoth $75 billion share buyback program. Earnings more than doubled to $36.5 billion from a year ago. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
This is not going to be an easy one for the Fed. I mean, currently the market is pricing 4.9%, let's call it 5% terminal rate. I think we could reprice a bit higher. The Fed has become a far maturing theme. We're getting close to the peak. And now the driving seat is global growth expectations. And this has been, reignited by the Chinese reopening. And this is what is driving the markets.
Vasilya Giannakis on Citigroup looking at the international ramifications of speculation and hedging on foreign exchange in this earnings season. Lisa Abramowicz and I are looking at the foreign exchange effect for multinationals. And I'm going to say so far it's like a four-ish.
Yeah.
It's like in-betweeny.
Well, it's in betweeny because you have the hit that people took last year and then the expected tailwind that they're going to get this year from a weaker dollar. So people are saying it'll be offset and it's a wash. So, people can kind of look past an FX effect that in some cases were hundreds of millions of dollars.
It can be like real money, but the rule of thumb here, folks, 2-3% is like normal. And last year was ugly, 5?
Yeah.
You saw some 7%. And now you got a foreign exchange effect of 4%. So it's in between is where we are right now. This is a joy. We did this on short notice. We've had so many surveillance corrections today that somebody said, save the show. And we do that with Joseph Feldman. Joe Feldman is with Dana Telsey at Telsey Advisory Group. And what I love about Joe Feldman is he doesn't write 15-page notes. He writes like 4-page specials and cuts to the chase. We're going to devote this section to Amazon, which everyone on radio and TV uses Joe Feldman. Have they lost their step? I mean, when you look at Amazon, Joe Feldman, do you say to yourself, the boxes in our houses, in our stores, the ubiquity of it, that it's threatened?
I would not say it's threatened. However, we're maybe seeing some normalization where, they're not immune to the consumer slowdown that we've seen in the past couple of months and the concerns that we have about consumer going forward. You add on to the fact that their AWS business, which is their cloud business, has been a little bit slower as well because cloud computing's been slower. They were a huge beneficiary during the pandemic with people shopping online and buying and having those boxes shipped to their homes. But since then, they've had to readjust.
Joe, this is important, and it's what's going to be unspoken on the conference call, which you're on. They shake in trepidation out in Seattle when they go, Mr. Feldman next. Joe, real simple. The cloud guy, Jassy, has come in to pick up the pieces. And the great unspoken is about the guy before him. Did Mr. Bezos screw this up? Or did Mr. Bezos take his eye off of it because he was down in Hollywood figuring out the next space flight?
Well, I do think that the management got a little ahead of themselves during the pandemic, and they were trying to, keep up with the demand. And as a result, they built out their capacity much quicker. And there was such an acceleration in demand, the capacity doubled. Or was increased by 50%. Sorry, not doubled, 50%. And that was, arguably too much. It now has ebbed a little bit, and they've had to readjust and bring that back down. So that's where you could say management, I wouldn't say took their eye off the ball. I think they were doing what was right for the consumer, but then they got kind of stuck and have had to backtrack a little bit. So there was some erosion in the profitability at the same time that sales were slowing a little bit.
Joe, we know the story, and this has been really the question. How much of it's been priced in, given that these shares lost 50% of their value last year?
Well, that's a great point. I do think a lot of this is actually priced in. Now, I know, earlier this week when we did our preview, we did lower our price target to $125, but that's still, 25, 30% upside from where we are today. So we still very much like Amazon, and we actually think this could be a very nice recovery year for them in terms of better profitability, especially as the year progresses and they start to lap some of the challenges that they faced in 2022. So from a stock perspective, it actually feels like a lot's priced in, and I think there's some optimism what 2023 might prove out to be.
We've been talking all morning about the changing workforce, the potential for retirees to get back to work, as some people in the UK are calling for, and this question of artificial intelligence and how it affects some of the biggest employers out there. I look to Amazon and what they're doing there. How much is that part of that recovery story in terms of automating parts of their warehouses and really leaning on that to fuel their growth?
Yeah, I think Amazon has been on the forefront of leveraging technology to fulfill customer demand. It's certainly among retailers. And, they're one of the leaders. They were very early, leveraging robotics technology, and I think that's going to continue to help them be more efficient in the future.
Joe, a two-part question, but linked together, and this goes back to the pre-pandemic analysis. Okay, Amazon stumbled, But do they get an EBITDA margin back, which I'm going to estimate, let's call it 14, 15 cents on the dollar. And with that, do they flip to free cash flow that can exceed the wonderful year of 2019? Is this the year that happens?
Well, I think this could be a nice recovery year for them. And we do think that you're going to see, as you said, that, kind of 14, 15% type EBITDA margin this year, and could see some really healthy recovery. I do think this will be a decent year for Amazon. I think they can operate more efficiently. I think that, they're controlling their costs, they're watching their labor, they're leveraging the technology, and if they can, maintain some solid level of consumer demand, which we would expect. I mean, we're still forecasting sales to be up, 10 or so percent, 11% this year. They should be okay. I think it'll be a good year for Amazon.
How much is that belief, that optimism, Joe, hinging on a macro call of greater consumer spending versus an idiosyncratic story of a company that has adjusted and adapted?
Well, it's a great point, because I do think that some of this is related to the consumer holding up somewhat. We are forecasting, some slowdown, certainly in the first half, maybe middle of the year. We're hopeful second half starts to recover a little bit towards the holidays again. But I do think that Amazon's taking market share and continues to take market share across many different categories. They got very aggressive with their, the prescription pharmacy plan that they offered the other day to Prime members. And, that's just like one small element. They're getting deeper into grocery. They're doing so many things that can capture market share to help offset some of the slowness in the broader consumer.
They're getting deeper into grocery. Do you suggest they will expand whole paycheck from sea to shining sea?
Well, they really like their Amazon Fresh format, too. So I think that we're going to see more of those Amazon Fresh stores. There's already one in New Jersey over in Paramus, and I think that we'll see more in the Northeast and across the country.
What's Amazon Fresh, Joe? Inform me.
It's essentially their version of a grocery store. It's like a traditional grocery store, but it has the bells and whistles of the technology where you can go in, you scan your phone or even your palm, and it attaches that to your credit card, and you can shop the store and walk out without even seeing a cashier.
Are the
so the technology makes it easy.
Are the avocados cheaper there than at Whole Foods?
Well, yes, and Amazon they're positioning the fresh concept as a more moderately priced grocery store relative to Whole Foods.
Joe, everything is more moderately priced than...
I love that you're doing your shopping with Joe Feldman. You're doing literally your,
But you and I are so behind on this. I mean, there's so much technology in food now, and Amazon's trying to do it. I've never been in an Amazon Fresh, but like he says, you just walk in with your phone, and
it tracks you.
It tracks you or whatever.
Yeah, so you can just walk in, walk out. I have not, no, but I've done other technologically induced food experiences.
Remember it's a Velveeta. remember the magic of Fairway on the Upper West Side, and that was just so original.
But it wasn't because of technology. It was also some of the goods and what specifically you could buy there, and the sort of specialties that you could purchase. This just crossed, and I do want to bring this up, that there are more people now falling behind on car payments than at the peak in 2009.
Interesting.
So we're talking about the resilience of the U.S. consumer, and yet you see this issue after the prices of cars just exploded during the pandemic.
I mean, the old $250 a month is now what, $400 a month?
There are people who are paying more than $1,000 a month, which is basically like another mortgage, depending on what they finance.
I paid off the Nash Rambler in 1968.
And when was the next time you bought a car?
No, I still have it. It's great. I don't take it out much in the winter, sometimes with chains, but no, I don't.
Chains. So if you hear that clunk, clunk, clunk down Fifth Avenue, that's Tom Keene.
This is Bloomberg. Good morning. Bloomberg Bloomberg surveillance from New York and from London. John Ferro in London. Look for the 9 o'clock soiree with Mr. Ferro here. He'll do that here in about 30 minutes. We have been remiss today. Lisa, you and I have failed in earnings season. We haven't played up the economic data.
I was about to say, which aspect?
Yeah, there's too many aspects, but yeah. we really have underplayed this important economic data.
Especially because it's some of the key data that the Federal Reserve looks at ahead of their meeting next week. But really, the core PCE is going to be interesting to me, and income and spending, and we're getting those figures right now.
Income data coming in right now, and that means Michael McKee will dissect, like he did, a buoyant GDP statistic earlier this week.
Well, buoyant on the headline, not so good down below, but that's okay. We'll take it. Here's the numbers you want to see. The PCE deflator up 0.1%. That matches last month. That is a little bit ahead of the expectation for a flat reading. On a year-over-year basis, pushes us down to 5% from 5.5, and the core rate is up 0.3, a tenth more than last month, but that matches expectations, pushes us down to 4.4% for the year-over-year. That's down from 4.7%. So obviously the Fed is getting some progress in its inflation fight. Personal income's up 0.2% on the month, and personal spending down 0.2. Those both match estimates, so bravo to the economists who did the forecasting. The incomes number down from a revised 0.3 last month. Spending is down from a revised -0.1. Interesting note here, guys, that and this didn't show up as much in GDP because that comes out as a quarterly number. October personal consumption was up, but November and December down. So the sequential move is to a slowing consumer at this point.
I want you to go to the basics here. I'm always looking as an amateur at year-over-year PCE deflator, and as you mentioned, 5.5 down to 5. But you've been lecturing me in the last 90 days, month-over-month matters. Into this new year, is month-over-month more important to you and the Fed than year-over-year?
Personally, I don't care. But to the Fed, no, seriously, to the Fed, it matters because what they're trying to do is eliminate the base effects from last year, and they want to see what the sequential progress is. If you were going to do a comparison to last year, you might want to do something compared to, say, March of last year when they started raising interest rates. So the year over year is what gets the headlines and what kind of the consumer looks at, but the Fed's looking at the sequential change because they want to make sure that they're getting a regular decline in the numbers. Let me just give you this savings rate. It went up to 3.4% from 2.9%. So that was a concern out there that people were spending down all of their leftover stimmy money, and now it looks like they kept some aside in the month of December. Wages and salaries, though, they sort of decelerate. 0.3. November was 0.5. Now revised down to 0.3. So a little bit of slowing on the wage and salary front, which is also going to be good news for the Fed.
Well, basically, this is not really that newsy for the markets. They're basically stasis across the board as people priced in most of this. This was pretty much bang in line with expectations. The one area, Mike, that I want to focus in on, though, real personal spending. When you strip away the inflationary impulse behind it, it dropped more than expected. Are we seeing a consumer that is being warned duly by what's going on and pulling back ahead of the storm?
Well, I think that you're seeing basically that. Now, is it because they accelerated all their spending into October and September was also large as well because they felt they needed to get their Christmas shopping out of the way early? Or is it because people are really pulling back? This is something of a seasonal thing. The last year we saw basically the same dynamic. So are we seeing a change in consumer spending patterns? But you're right, real personal spending lower. Now you're taking inflation out of that. Real personal spending up 0.3 compared to a 0.2 decline last month. So, you know, it does show a slowdown. Now let's see what happens in January when Tom goes to Amazon Fresh and shops.
This will be a test effort. Michael McKee, thank you so much. Getting ready for the Fed meeting next week. Red and green on the screen. A nice recovery here off the report just minutes ago, and the yield space up 3 basis points, and the 10-year yield 3 1.53%. We're watching oil nearing $90 Brent crude. This is a joy because it is the heritage of what Neil Sauce did at Credit Suisse. He is Ray Ferris, their chief economist, joining us, and he and I are on the same page that everybody inflation adjusts. And Mr. Harris and I go, maybe not. Nominal GDP matters. What is the global Credit Suisse outlook on the dynamic of nominal GDP with disinflation in place?
Well, that's absolutely right. The key thing, I think, for corporate profitability, the outlook for earnings, is really nominal money. And nominal GDP growth, after a boom in 2000 and late 2021, early 2022, is now slowing a lot. That's the disinflation process. So what that means is that at the top line, revenue growth is going to come down. We're already seeing that. There's a good link between nominal GDP growth swings and margins. Margins are going to come down, and we're seeing that. And although we think that there will be consumption growth in 2023, that consumption growth, especially in the goods sector, is going to be very, very weak. So slowing revenues, squeezed margins, and not a whole lot of volume growth.
Sitting in that chair this week have been a number of people modeling out some form of reaction function, trajectory, whatever you want to call it, down to a level of disinflation that I think would shock our listeners, shock our viewers. 4%, 3%, some even modeling under 3% is an inflation picture for the United States. Are central bankers prepared to have their minds change when the facts change?
Oh, the Fed's already moving. I mean, you can see that the Fed, that this shift from 50s to 25s, and I suppose recently the comments out of Lael Brainerd suggests that the Fed is beginning to kind of adjust to the fact that the economy's weakened and that it views itself as being in restrictive territory. And at some point, it's going to pause. That's the right thing to do. What they're not ready to do, because of the level of inflation, and Mike just identified this, I think, nicely. There's the month-on-month stuff, which looks pretty good, but then there's the fact that what the public cares about is the year-on-year numbers, and those things are still high. So the Fed is going to have something of an asymmetric bias toward hawkishness until it can get those year-on-year numbers down to safe territory. And I think that's below 3%.
So you mentioned Lael Brainerd. Let's go there. Some people, including Citigroup's Andrew Hollenhorst, saying that if she does take the job with the White House, this could actually increase the hawkish tilt of the Federal Reserve, that she was actually more of a moderating voice, saying maybe the risks are a little bit more balanced. Do you agree?
Well, maybe. Or, you know, I think there's probably some extent to which she's also been a trial balloon. You know, and this Fed seems to me in their communication strategy to have been much more coordinated and sort of game planned than, say, Feds of 3, 4, 5 years ago, when it was really just a talking shop in public.
When it comes to the actual economic data, how much are people overlooking the Chinese coming online, the fact that China ended zero COVID and we're going to get some sort of boost with the consumer spending that perhaps could also juice demand for commodities and for other goods?
Exactly. We just wrote about this, and we think that at a global level, the impact this year is going to be pretty modest, at about 0.2% of global GDP. Most of that is going to be focused outside of China. Most of that's going to be focused in Asia. Countries like Thailand and Singapore, the Philippines are going to benefit as the Chinese begin to travel abroad again. In Europe, maybe a small boost, 0.1 to 0.2%. The United States, very small. The key thing is going to be the impact on energy prices. And this is one of the reasons why the Fed, at this stage, even with a succession of pretty good month-on-months, can't take for granted victory. If, for whatever reason, the Chinese manage to drive up oil prices well above $100 a barrel, well, headline inflation is going to return to being something of a problem.
Yeah, but you're underplaying your knowledge base here. You own the Pacific Rim for Credit Suisse for years and years and years. Nobody's hit Raffles Bar like you. The bottom line is you're suggesting Brent crude with Pacific Rim oil demand coming back. Are you suggesting it could pop above 100 and find new levels up at 110, 120?
That's not our forecast set. Our forecast set is, kind of around 90, about where we are right now. What I'm saying is that it's been very, very difficult to predict.
Yes.
We have to recognize that the energy markets are very tight. we're not getting as much of a response out of the United States in the shale patch. OPEC is sort of back in control. So, if I were the Fed, I'm sitting there, is there a chance that despite all my forecasting, that oil surprises to the top side and that really damages my inflation outlook? Yeah, there's a chance. So I can't take that risk.
Again, with your history of the Pacific Rim, do you just model out yield curve control goes away and we get yen stronger back to where we knew it?
I think that's right, but only after the new governor comes in.
You're going to wait till the spring?
So we need to get the new governor in April, and then we need a policy review, and then probably in June we'll take away yield curve control. But note that the BOJ has a new facility that allows it to lend to banks against JGBs at sub-market yields. So it's created a facility that will allow it to manage the process of 10-year JGB.
To me, it's almost like It's almost like sterilized currency moves. They've set up a sidecar move.
Correct.
Almost like a sterilized yield curve control.
So it's the one place that wants inflation. So externally, the IMF may be excited about Japanese inflation. Well, so are the Japanese, except in the opposite direction. They want it.
Yeah. Ray Ferris, thank you so much with Credit Suisse and some serious Pacific Rim cred there as well. Red and green on the screen. Lisa, bonds lift here. What do we see? We got another tranche of economic data coming out here at 10 o'clock.
Yeah, the University of Michigan Sentiment Survey, which perhaps will give some insight into why people are saving more and spending less. That is the theme that I can see, that people are kind of girding for a winter that hasn't come yet.
I was unbriefed on this. Pending home sales at 10 o'clock, to me, is not a small issue. Liz Ann Saunders was heated that she's watching home economics, if you will.
It's the first
more than anything in America.
And we're not talking different cooking classes, but this question of whether we've seen the bulk of the Fed moves in the most sensitive area of the economy, and that is the housing market.
And the housing market and the labor market as well. Goodyear Tire, far, far off the radar. Goodyear Tire to cut 5% of global salaried staff. This is special. Richard Haas out with a new book. Ambassador Haas will join us here in a moment. Stay with us. Red and green on the screen. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The UK's Chancellor of the Exchequer is dismissing calls for tax cuts. In an exclusive interview, Jeremy Hunt told Bloomberg TV, quote, "We don't have the headroom." He also pitched Britain as a hub for high-tech industries and innovation.
I think we have the opportunity with our universities, our financial services, and our technology strengths to be a Silicon Valley.
Meanwhile, Hunt also pushed back up against U.S. and European plans to subsidize green industry, which threatened to divert investment from the UK. It's been almost a year into the invasion that Vladimir Putin figured would be over within weeks. Now, Bloomberg's learned that the Russian president is planning a new offensive in Ukraine. He's also bracing his country for a conflict he expects to take years. The Kremlin wants to show its forces can regain the initiative after months of losing ground. The idea is to force Ukraine to agree to some kind of truce. Customers using American Express spent a record amount last quarter, and the credit card giant predicts that revenue and profit for this year will surge well above estimates. Amex has been tweaking rewards on many of its cards, and that has helped it add millions of new cardholders last year. And Americans are falling behind on car payments at a higher rate than during the financial crisis in 2009. According to Fitch Ratings, the percentage of subprime auto borrowers who were at least 60 days late on their bills rose almost 5.7% in December. And that's more than twice the record low set in 2021. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Look, if Republicans want to work together on real solutions and continue to grow manufacturing jobs, build the strongest economy in the world, and make sure Americans are paid a fair wage, I'm ready. But I will not let anyone use the full faith and credit of the United States as a bargaining chip. The United States of America, we pay our debts. It took 200 years to accumulate that debt.
The President of the United States there driving forward the story of maybe late summer or autumn, the debt ceiling debate. We tried to avoid it this week. We failed. It is there. It is ever and ongoing, and will be a political football into the Sunday talk shows as well. It just won't go away, will it?
No, and even if they kick it down to September 30th, it's not going away.
Lisa Abramowicz and Tom Keene here. John Ferro getting ready in London to move the story forward here on economics, finance, investment, red and green on the screen. And we are going to stop right now. We can do this with Richard Haass. It was my book of the summer, book of the year. I can't remember right now, but his book on how to figure out the new Western civilization 101. The world was so important, and he comes back with a jewel. It is the Bill of Obligations, but far more, Lisa. This goes back, and this is corny, but unbelievably tangible right now. A scout is trustworthy, loyal, helpful, friendly, courteous, kind, obedient, cheerful. I memorized this once. Thrifty, brave, clean, and reverent. Richard Haass takes us back to another time and primarily screams for some civility within our fractured American society. Congratulations on the 10 Habits of Good Citizens.
Thank you, sir. It's so interesting you quote the Scout's Oath. The Scouts are one of the very few organizations in America, Girl Scouts and Boy Scouts, that actually teach civics. They actually are invested in the fabric of this society.
It changed me. It was the whole Eagle Scout thing a long time ago and all that. How did we get here? How did our society get to where you had to write a piercing 140, 150 pages on America, get your act together?
A couple of reasons. One is we don't teach our story. The fact that we don't teach civics in many schools, if we do teach it, it's inadequate. You can graduate from virtually any college or university now, Tom, and if you navigate your course distribution right, you'll never study physics. Yep. Civics, you'll won't understand the basics.
Or physics for that.
Or physics for that. Sorry about that. So there's that. I think media and social media has contributed to it. Increasingly, people go into their own ecosystem or ecosystem, whichever you want to call it. They go for things that confirm their biases. Social media is much more about social than news, but this is increasingly where people get not their information, but their misinformation. I think people have also become more skeptical of government. You know, things you talk about on this show, the failure to manage the economy well, things like the wars in Iraq and Afghanistan. It's created a sense of populism in this country for any number of reasons. There's been backsliding here. And by the way, it's not unique to here. We see it in Brazil. We see it in Mexico. We see it in parts of Europe. I think democracies are under pressure. We just never thought it would happen here. We're the world's oldest democracy. We're the case.
Jeff Sachs screamed about this out of Columbia 10 years ago, even 12, 15 years ago, talking about the fractured American education system. What's the best practice model out there worldwide that we can learn from to begin at the margin to improve our social education process?
Well, we have some good examples. Yeah, we still have the best higher education in the country, in the world. I would say the problem is, again, we don't require certain things. We offer them.
You call this the Oberlin model?
I would not put that at the pinnacle. But no, the people line up around the world to go to American universities. The problem is universities let people off their campus without requiring them to do certain things. Finland, for example, has just recently started an experiment for high school kids. You want to go through elementary school and high school, you have to become what's called literate in information. They teach you how to navigate this world of information, misinformation. What's a fact? What's something else? What's an opinion? They just, by the way, passed that. Interesting enough, one state in the 50 states has that rule, that law. New Jersey just passed it the other week. Every New Jersey high school graduate is going to have experienced information literacy.
Well, you wrote this book. There is more than one page, but you handed us this card, which had the ethos that you are trying to espouse.
Thrifty.
And how much is this really an indictment of the moment that we're in terms of people's attention span and ability to focus? In other words, do you see any progress in the places that you're basically saying for civics that could actually salvage what you're hoping for?
I see the potential for progress. Almost every group I speak to, and in some ways the reason I wrote this book, people know there's something wrong. Americans get it. Look at the polls. They've lost confidence in the future. People know there's something wrong. There's a lot of interest in teaching civics. People know that something's going seriously wrong in Washington. They're alienated from their government. So I think the potential for reform is there. The question is whether we can get sufficient involvement. The fact in the recent midterm elections, given all the stakes, less than half the eligible voters voted. That's something wrong. We've got to get people more informed and more involved.
How does this really dovetail to the U.S.'s position internationally as someone who has been in the diplomatic world for your entire career, and considering the fact that the rest of the world sees the dysfunction in Washington and reacts to it?
100% right. The Chinese like nothing more than to show pictures of things like January 6th on their television and go, see? The quote-unquote democracy is the same as anarchy. So the authoritarians love it. Makes it very hard for us to say, emulate us when we don't look very good. More important in some ways, it makes it very hard for our allies to trust us. They see the discontinuities that have come into American politics. They no longer have the assumptions of reliability. And I think our foes, for the same reason, are much more willing to challenge us because they're not sure we're going to be there.
On radio and television, Richard Haas with us as we celebrate his new book, The Bill of Obligations. Can't say enough about it, 150 pages here. And now we're going to migrate to Richard Haas, Oscar analyst, expert on movies. There I was watching, I call it The Banshees, the Irish movie that's up now. And I thought of you. They're looking across the harbor at the war going on in Ireland. You lived it. Did you see that movie? And what did it bring back about the Irish tension that is and will always still be there?
I did not see it.
You have to see it.
I know, but I've been kind of busy, Tom. But two things. One is that a lot of those issues, not so much the Ireland English thing, but the problems in Northern Ireland, Brexit. One of the many consequences of Brexit, it has reintroduced friction into Northern Ireland. Northern Ireland went through three terrible decades of the Troubles. I don't think now it's inconceivable that we could see some sort of a reintroduction. Clearly, we're seeing greater friction there. And by the way, given what we're talking about this morning, it's a warning for this country. I'm not worried about a new civil war. I am worried about an American version of the Troubles, where we have politically inspired violence around the country. It is not inconceivable. No one should think that January 6th is a one-off. Look, you got a big business audience in this show. Businesses, besides thinking about ESG and DEI, businesses ought to be thinking, what can they do to promote American democracy? They have an enormous stake in the rule of law.
Just real quick here, before we let you go, you were talking about social media, the involvement there. There's a push to ban TikTok, in part because of the Chinese ownership. Do you think that restricting social media is the answer?
It's part of the answer where we have to restrict, we have to regulate it. What are the responsibilities of the carriers? Are they publishers? Are they simply pipelines? I think that. But more important is probably to make the people who go to social media more discerning. How do we make them understand the limits of social media? Again, I want people to be citizens, to be critical consumers of information. Ronald Reagan called for patriotism, but first he called for informed patriotism. What we need to do is make sure we are critical consumers of this information soup that we're all living in.
Richard Haas, thank you so much, and congratulations. And I don't like the cover. The cover's like a Ralph Lauren sweater thing with the American flag on it torn away. And what I would really emphasize to our international audience, the Bill of Obligations is not just an American book. It is an international book about learning the civics that we all know. I love it. Eddie Glaude says here, democracy is more than procedures and laws, an ethical ideal. And Lisa, that sums it up for
well, and also knowing each other other than just what people say in your vacuum in the social media sphere. And that's important, you know, how bifurcated everybody's news streams have become.
I mean, at home, they keep a calendar check on every 90 days. I start screaming about lazy-ass kids who go, how can we stay informed and all that? And I go nuts. I say, it takes work. Well, you have to work at it.
I actually was having a conversation with someone who is in my home about the potential influence that they get from the media that they read on TikTok or Instagram. And they told me, you know what, it's not a big deal. I can discern what's, you know, manipulative or what's potentially influencing me in one way or another. Really? I mean, honestly, this is some of the questions that need to really be discussed.
We got to get ready for next week, a Fed meeting and earnings. As you mentioned earlier, important earnings about the pulse of what America does best, which is technology.
Big tech parade. We got Amazon, Apple, and Google, or Alphabet, as some would call it, on Thursday.
We continue forward on this Friday, and very importantly, in 64 minutes, key economic data. Stay with us on radio, On television, this is Bloomberg Surveillance.